fine overall. The team at Goldman predict the Fed will cut rates by a quarter point in September, November, and December. Meanwhile, JP Morgan and Citi are calling for the Fed to deliver a half-point cut in September. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, big tech leading big losses.
The reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, that doesn't make sense in an economy that's moderating.
Up next, Ed Yardeni of Yardeni Research, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
John Stolfus, Oppenheimer, is the quote from him. Last week's equity market downdraft on the back of the jobs data, in our view, likely provides opportunity for another rally. No change from the team at Oppenheimer. We'll come back to that note a little bit later. Your scores look like this. We're down 2.8%. Not on the month, not on the week, on the day, on the session. We're down by 2.8% this morning on equity futures. This one's an ugly one. In the bond market, the rally continues. We're down 5 basis points, 373.97. And speaking to the growth scare, crude lower by 1.7%, WTI 72.27. Under surveillance this morning, big tech leading big losses.
The reality is tech is also rate sensitive. And in addition, if we do start to think that, if nothing else, the economy is going to be softer, some of the trades that people were running into in July, that doesn't make sense in an economy that's moderating. If anything, you're probably going to be more inclined to look for a higher quality, revenue consistency, earnings consistency. Where do you find that? You find that in a lot of the mega cap tech names.
A lot of you looking to pick up the pieces. Some people taking the other side. That's what makes a market. Here's the latest. The global stock sell-off continues, ignited by weaker than expected economic data. Traders are waiting more data this week. We get the ISM Services Index coming up today at 10 a.m. Eastern Time. Ed Yardeni of Yardeni Research has this to say. A weak July employment report does not a recession make. The financial markets reacted on Friday as though it does. But we believe that report was a weather-impacted anomaly and not representative of the strength of the U.S. labor market. Ed joins us now for more. Ed, thanks for jumping on with us early this morning to go through some of this. These are some big moves. Let's just start with your point. What about Friday tells you that that's the anomaly and not the start of a new trade?
Well, I think to a large extent, the Friday sell-off had more to do with the carry trade unwinding The Japanese central bank and the finance ministry have indicated they want to see somewhat tighter monetary policies over there. And apparently, we never really appreciated the scale of these carry trades. It just happens that all these things kind of came together on Friday. I think the markets did have the SOM rules scare that, you know, the unemployment rate's gone up a little bit, and the next thing it does is it goes up a lot. But history shows that really only happens when you get a credit crunch. Now, it's conceivable that this carry trade unwind becomes some sort of financial crisis that in turn leads to a recession, but that's not where my thinking is at. The other issue, of course, is geopolitical risk, and everybody's kind of nervous about the potential for a wider war in the Middle East.
Except crude selling off, which speaks to the overall concern, the overarching concern about growth in America. So, Ed, if that's your view on things, just go through things right now, in equities, in bonds. Do you think we've overdone it in equities, in stocks, in fixed income, in bonds, or both?
Well, I think we've overdone it, and I think a lot of it is the forced covering of these carry trades. It's hard to assess how much more we've got to go, but you know, these traders move awfully fast, and we're seeing that in this kind of vicious sell-off on a global basis. I think the fact that it's a global sell-off has more to do with the carry trade than a couple of numbers here in the U.S. suggesting the economy is weaker.
But you talked about one of the risks that you're not worried about at this moment, but the risk that the sell-off gets people to think that there's going to be a recession, act like there will be a recession, and a recession happens. At what point do you get worried about that risk?
Well, I'm worried about it now. I mean, clearly, when you see these kind of sell-offs, you wonder what you're missing. I mean, this is very reminiscent so far of 1987, when we had a crash in the stock market that basically all occurred in one day. And the implication was that we were in or about to fall into a recession, and that didn't happen at all. It had really more to do with the internals of the market. And I think that's the same thing going on here. I think a lot of this sell-off has to do with this carry trade unwind, and it's conceivable that it could feed on itself and create its the worst scenario where everybody hunkers down and says there must be a recession out there. But I don't think so. I think the labor market's still in good shape. I think the U.S. economy is still growing. I think the service economy is doing well. I guess we'll see very shortly here. But all in all, I think this will turn out to be more of a technical aberration in the market than something that turns into a recession.
And I hate to hammer on the bearish base case, because I know it is not yours. But if it is conceivable that something like that could happen, that kind of feedback loop could happen, is it then conceivable that the Fed does something like a 50 basis point cut or even an emergency cut?
Yeah, absolutely. I mean, this is turning into a global financial panic, and I think we can expect that the central banks will respond to it. And I think their initial reaction will be to try to lower concerns about the U.S. economy and to push back against the idea that they're going to do 50 basis points. But, you know, another couple of days like Friday and this morning's future sell-off, and I think the central bank will be going into, the mode of providing liquidity. And that could very well mean a 50 basis point cut.
Do you think they are in a position to activate the so-called Fed put? I'm going to share this quote with you from Peter Chia of Academy. If the Fed does anything that looks or smells like they're eager to embrace the Fed put, we would likely see inflation starting with risk assets. They're caught between a rock and a hard place in terms of being able to be aggressive. How constrained do you think they are?
I don't think they're constrained at all. I mean, if they conclude that this global liquidity sell-off in the carry trade has the potential for causing pushing the U.S. economy into recession, they can move pretty quickly. I mean, they could even move before the next meeting. I don't think they want to do that because that would signal that they're getting panicky, but the markets certainly are panicky enough to have an impact on Fed thinking.
Ed Giardini, of Giardini Research, thank you, sir. Drawing a distinction between what he thinks is just an unwind of the carry trade versus, say, some fundamental growth shock. triggered by the data we got last week.
Exactly, but as he was saying, there is this threat that it feeds back on itself, and it in itself causes a growth shock because you have people pricing an emergency cut, therefore the Fed does an emergency cut, therefore we panic, think there's going to be a recession, act like there's a recession, and then a recession happens. But I think the through line with everyone we've been speaking to this morning, John, is that is a threat, but that threat is kind of in the background now, that the data has been strong, and sure, there's a sell-off in part mechanical, and it could get worse, but this isn't it. This isn't a recession right now.
Yeah, after Friday, I'd say this wasn't just a fear of going into recession. The market started to behave like we were in one already around this SARM rule, and I can't wait to catch up with Claudia Sarm. Claudia Sarm of New Century Advisors on her SARM rule is joining us in about 5 minutes' time, so don't miss this. We've got lots of commentary for you on the sales side. This from Ian Lingen of BMO. The shifting sands of economic sentiment will define trading in US rates during the week ahead. Price action in risk assets will cast the final vote on how far the bond bullishness is able to extend. And this market's casting its vote right now, and it's pretty negative. On the S&P 500, we are lower. On the NASDAQ, we are down. On the Russell, we are aggressively lower. On the S&P, we're down by 2.8% on the S&P 500. From New York City, good morning to you all.
authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So there's plenty of bearishness out there. Here's the more constructive view on this equity market from John Stolfus of Oppenheimer. We note that with Fed funds at 525 to 550, monetary policy officials have ample dry powder to manage the landing. He thinks there's an opportunity here to buy this market, and this market's still selling off. We're down by 3% on the S&P 500, negative by 4.5 on the Nasdaq. We're off by 4.5% on a Russell 2000. The small caps all over the place. Danny Berger alongside me throughout the morning. Danny, we were down almost 7% on the Russell just last week, and we add to those losses on the session so far.
With all of these moves, and small caps maybe the most of which, it's so painful because you just had so many people come out and say now is the time to buy small caps, that this rally can sustain itself. Even with the broader market, you had people coming out calling for 6,000 on the S&P 500, people calling for even more when you look out into the future. That all literally just happened. I know hindsight is 20/20, but you could look at that and say, maybe that was something like the top.
Some of those people are still calling.
Sure, absolutely.
For some of those numbers, and that has not changed since Friday for those individuals, and Stolfus is one of them. I want to turn to the bond market. Coming on to Monday, through the weekend, through Friday, we were on a 4-day winning streak on a 2-year, a 7-day winning streak on the 10-year, and you can add to that. Make it day 5 on 2s, day 8 on 10s. The 2-year down 15 basis points to 373.36. Danny identified this earlier in the session. I think we should sit on it just for a moment. Look at the difference between a 2-year and a 10-year. Danny, we're down to a single basis point.
Exactly. We are so close to this thing uninverting. And again, that's when many people have said, it's not the inversion that matters for the recession, it's the uninversion. But you got to bring it back to Jay Powell himself, talking about the SOM rule and the inverted yield curve, saying that it's different this time. They are just statistical normalities. They don't actually tell you anything at this moment. And again, it goes back to the panic of this market, even the panic of some people in Powell's press conference being very dovish, and Powell and Goolsbee on Friday being extremely calm. This is not a market that is calm.
The P word is not a word we use lightly or loosely on this program, but if you look at Japan, I think we can use it. This is what panic looks like. A 12.4% move on the Nikkei 225. Think about everything that's happened between now and 1987, and yet this was the biggest move since 1987 on the Japanese benchmark.
Yeah, on what, the BOJ hiking? I mean, you have to scratch your head and say, fundamentally, this is an odd move. But it gets less odd when you think about all of the people, again, this goes back to the small cap thing, of all the people who piled in to Japanese equities, of all of the people who are just glomming on to this carry trade. And then what happens when it unwinds? This is the kind of thing that, again, it might not be fundamental, but it certainly has a mechanical feel to it.
Dollar yen is down for 5 days. Over that period, we've had a move of 7.4% in the yen's favor. That's a massive rally on a single currency. And as Danny and others have pointed out, there's a lot of trades that build on top of that short Japanese yen trade that developed over the best part of the last 2 years or so. That's the FX market and what's been happening in Japan. Under surveillance this morning, the global stock sell-off, ignited by weak payrolls data, continues today. Big tech leading the drop. Check out these names: Apple, Nvidia in the pre-market, lower and lower aggressively. Nvidia down by 11% in the pre-market. And you've got to wait until the end of August to get earnings from this player.
And that's why, again, Russ Kostrick started us off with this, that I think was really the tone of, sure, these are names you want to buy, and a lot of people have been waiting for the sell-off in order to buy them, but can you really jump in with both hands this morning? And perhaps you can't, because the losses could get worse. But again, it goes back to the Dan Ives of the world saying, there's still value here. I still want to be long these stocks, but it doesn't mean that there won't be more pain in the short term.
Looks like a growth shock, feels like a growth shock, sounds like a growth shock. Check out the commodity market just to confirm that. You've got all this tension in the Middle East, all this tension, and yet crude is lower on the session on both WTI and on Brent, as we're all sitting here waiting to see how Iran retaliates against Israel in the Middle East. This is what's happening with crude. We're pulling lower by 1.8% on WTI, on Brent crude down by 1.6%.
And it will be a vicious move if something does happen, because it's hard to make the argument that you should be selling oil if there is more geopolitical angst, if there is something that does look like escalation, because that had been the big fear of this market, of Iran retaliates in a way that isn't just like July 13th, where essentially you can just block all of the missiles coming in and it's no big deal and you carry on as they were before. If that does happen and you get more volatility in oil, again, it's just another asset class that will be swinging from huge gains to huge losses. does that just feed into the market volatility all over again?
That's the Middle East and the commodity market. Let's just pause. Let's take a beat. Let's park all the price action and just sit on this. I know many of you have heard this phrase in the last few weeks. In fact, for the last few months, we've been talking about the so-called SARM rule, the rise of the unemployment rate in July triggering the SARM rule, a recession indicator for so many, which has a perfect track record over the past half-century. Claudia Sahm herself of New Century Advisors saying this: I don't look at this and big picture say we are in recession, but I look at this and I say we're not headed in a good direction. Claudia joins us now for more. Claudia, you're famous if you weren't already. I think you know that anyway. It's great to catch up with you. I just want to take a beat and just sit on this for a moment. Claudia, let's go from the very beginning. Tell us what the SARM rule is, what you wanted it to be used for, and whether you think it's applicable in a labour market like this one.
So the origin of the recession indicator was in a proposal I had to improve fiscal policy, put it on autopilot, automatic stabilizers in a recession. It's a rule in the sense of not the economy must do something. It was a rule in the sense of policymakers do something. It may end up playing out that way. So, but what the idea of it was to look at the historical record in the United States and find the pattern, find the unemployment rate increase. It's very important to look at changes at which, in the past, the U.S. has been in a recession, months into a recession. This is not a forecast, right? And so it's just trying to capture, and yet it is absolutely true that it doesn't have to be that way this time. And frankly, if we look at all of what we know about the U.S. economy, right now, it is very unlikely that we are in a recession. And yet a really important question is, where are we headed? And those changes in the unemployment rate that the SARM rule picks up on, they do not look encouraging, right? They're headed in the wrong direction. And that momentum is what can get us in trouble.
So Claudia, for just all of those people out there who are talking about your name, who are talking about the SARM rule, using as an excuse to sell, using as an excuse to say that the Fed should be moving sooner. Just what do you say to those people?
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. You know, the fear does no good. And this, again, this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. And yet it's this balance between be calm, but take it seriously. Right? Like there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet. Usually the SARM rule, by the time it triggers, we're past that point, right? So there is this opportunity of, as I said, the Federal Reserve has a lot of place to ease. We do come into this in a position of strength, broadly speaking, in the economy. So that's really important for weathering a storm like this that has many different contributors to it today.
I didn't mean to use your pun as a segue, but I want to in terms of storm and weathering it, because on Friday there was just this huge debate when the numbers dropped of people saying, look, don't believe the numbers you're going to see because they will revert quickly, because a lot of it has to do with weather. A lot of it has to do with Hurricane Beryl. But by the way, the BLS comes out and says there's no discernible impact. Which side of this do you fall on, Claudia? Whether the numbers we saw on Friday are something that can somewhat reverse because it's a weather impact?
It's absolutely the case that any indicator, and the SARM rule fits into this, should not be designed to overreact to 1 month of data, right? So the SARM rule it smooths across months. The pattern it's responding to is a gradual steady increase in unemployment over the past year, right? So there's that. In terms of weather effects, the Bureau of Labor Statistics has the ability and the experience to look very carefully at the geographic data to get a sense of where its effects are. I think they take those statements very seriously, and I agree with them for a lot of reasons, including their statement, that the unemployment rate, specifically the SARM rules on, was not affected. The labor force status was not affected. Being home being unable to work because of the weather doesn't flip you out of being employed to unemployed. So it gets really technical in that, but absolutely, that 1 month, that was a big surprise. It was a -1. A prior of just some of them reverse is probably the right one, but it is the context of the year as a whole, and even moderate slowing and this increase in the unemployment rate has been in the past consistent with early in recession. So we might not be there, but we're getting uncomfortably close to that situation.
Claudia, you've worked at the Federal Reserve. You know better than most how that institution operates, how slowly it can move sometimes. How do you think it's going to respond to this data? Not just on Friday, but the data from Thursday as well, as we go into Jackson Hole.
On a day like today, when, as you said, the panic word is looming large for many people, the fact that the Federal Reserve is slow moving and deliberate, it's a good thing, right? The last thing we need is them joining into that that kind of that energy, that emotional energy, and yet they're watching it very carefully. The market functioning, liquidity, these are all the reason that we have the Fed is to make sure the markets keep functioning. Monetary policy then came later, right? So there is this aspect of them being diligent in terms of them looking at Friday's report and changing dramatically their views on a September rate change. I think that would be unlike them, and I think it would be premature, right? They're pointed in the right direction. They have some time to get there, but yes, they are slow moving, particularly when it comes to the economic data.
How do you imagine they'll frame that first interest rate cut? Do you think that's going to be framed as a mid-cycle adjustment, the process towards sort of normalization, or the first step towards taking a more accommodative stance, given what's developing? How do you think they're going to frame it, just given what we know so far?
Goodness, September feels like a lifetime away right now. Yeah, I think if they can, the Fed likes to move in on the path it set out. The path it has set out is to begin normalizing interest rates because inflation is normalized, and we are in, kind of everything is pointed in that right direction. I think they're going to want to keep to that narrative and to that path if they can. The last few days have called into question whether that is appropriate, will be appropriate at that point. And I will say one thing for the Fed, it is very deliberate. It can be very slow moving. But when the facts change and it gets its mind around it, it will move and it will do what it has to do. And we are in a position right now where they have the ability to do quite a bit. And that is notable.
And John made the point that both Citi and JP Morgan have changed their call now to see 2 consecutive 50 basis point cuts from the Fed. Claudia, what difference does it actually make, moving 25 or 50 in September?
It all fits within the context of that moment, right? If for someone changing to 50-point cuts, particularly consecutive ones, that's a pretty dire outlook for the economy when we get to that point, or in the intervening. That's not where my baseline is. I don't think that's where the Fed's is. I mean, looking at the data and where we're at, and yet, clearly, if we were seeing large moves like that out of the gate, there's a real problem. But we saw some big moves out of the gate in fighting inflation in 2022 in the other direction, and the Fed will take its policy to where it needs to be to the conditions in the economy.
Claudia, we appreciate your time. Just fantastic to speak to you personally. Claudia Sahm there of New Century Advisors, with the rule, the Sahm rule. And that Sahm rule has been butchered by a number of people over the last few months, but sort of setting the record straight there on where she thinks we are at the moment.
Yeah, I gotta wonder how annoyed she is that everyone's using her name as a pun these days. It's like somebody once told, like so many Sahm puns out there. I gotta feel for her for that. But talking about this idea that moving 50 basis points consecutively would mean something bad happens, does the Fed really want to do that? Because the data, again, to Claudia's point, it's not trending in the right direction, but it's not horrible. Does that signal the Fed knows something that we don't?
The difference between 25 and 50 is signal, and it goes to exactly what you just said. I want to keep going back to the central question we've been asking on this program now for months. Are we witnessing a welcome cooling or an unwelcome deterioration? Is this normalization or something more nefarious? And quite clearly, this market's casting a vote on what it thinks it is, what the answer to that question is, after Friday.
And does the answer to that question not even matter if the market is voting in this way? Is this a Fed that will have to respond as if things are deteriorating if the market runs away from it and it has issues like the wealth effect, meaning people really pull back and maybe business decisions aren't being made because of the equity market damage?
Yeah, this is that old adage that, markets can shape the events they anticipate, that George Soros stuff.
Right.
Like we've talked about this a million times. Is that one of these moments? If this continues, sure, It's a show me moment. Show me the economy is not as bad as this market thinks it is, and that starts at 10 a.m. Eastern a little bit later. The problem I've got with that argument at the moment is that the calendar for the data is actually really light now through the next week or so. Hardly got any Fed speak, 2 big data points for me, ISM at 10, jobless claims on Thursday.
And we also said that it was a show me moment for tech earnings, and they showed us, kind of, and it didn't do enough. And then if you want to wait for tech to do that again, you have to wait a while for NVIDIA. So in the meantime, our imagination can just run away with itself with investors who are impatient on AI really showing up, investors who are very long AI, and it's just an easy place to sell when there's a liquidity crunch.
NVIDIA earnings at the end of this month. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Vice President Kamala Harris is getting ready to announce a decision on her running mate. According to people familiar with her plans, the vice president met with at least 3 possible running mates yesterday. Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Other possible choices include Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker. Harris plans to kick off a tour of 7 battleground states tomorrow in Philadelphia, and her running mate is expected to join her. U.S. candy giant Mars is considering buying snack maker Kellanova in what could be one of the biggest deals in the consumer industry this year. That's according to Bloomberg sources. Kellanova spun off from Kellogg last year as part of a restructuring and includes brands like Pringles, Cheez-It, and Pop-Tarts. The deal would link those brands with Mars staples like Snickers, M&Ms, and Skittles. Kellanova shares have gained over 12% this year, with the company valued at over $21 billion. And it's day 10 of the Paris 2024 Summer Olympics. Today's events include finals in the triathlon, gymnastics, surfing, and track and field. Team USA is in the lead with 72 medals, while China is second with 50, and host nation France has 44. As far as the most gold medals, China is now in the lead with 21, and the U.S. at 19. That's your brief, John.
Yahara, thank you. Yahara's going to be back in about 30 minutes' time. Up next on the program, it's the path, not the destination.
Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination.
We're getting a lot of volatility right now. That conversation up next from New York. You're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy, with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures negative here. Near session lows, actually. We're down by 3.2% on the S&P 500. The rally in bonds continues, down 7 basis points on a 10-year, 371. We're down 15 on a 2-year, 373. And as Danny said a few times already this morning, the distance between a 2-year and a 10-year now, just a single basis point. That bull steepener continues. Under surveillance this morning, it's the path, not the destination.
The level in 10 years that we see at the pivot point is 385. So any yield below 385, we are better sellers, you know, with underweight duration. Above 385, we start going long duration. It is our full expectation that we'll test both ends of that. That underscores one thing. Our number one highest conviction trade for 2024 coming into the year was volatility. That means, and we're seeing it, and that means the path is more important than the destination.
We're definitely seeing it. Here's the latest. Treasuries surging with bond traders around the globe piling into bets that the Fed will start cutting interest rates. We're down another 14 basis points at the front end of the curve. Ed Al-Husseini of Columbia Threadneedle writing this: there is an uncomfortably high probability that we have entered a recession in the United States. With non-trivial odds, the Fed will have to act faster, including ahead of the September meeting. Stay long, duration. Ed joins us now for more. Ed, let's get into timing first, and then I want to talk about the nature of the rate-cutting cycle you're anticipating. Do you actually believe that there's justification here to move before September 18th?
Yeah, look, I think particularly if financial conditions start to tighten or continue to tighten at the pace that we're seeing at the moment, the answer is going to be yes.
How much more tightening would you expect, and where would you need to see it? Is it another 5 to 10% in equities? Is it 100 basis points widening in high yield? What would constitute sufficient tightening of financial conditions that the Fed would have to come out and say, it's time to go, we can't wait around?
Yeah, I mean, it's really a difficult judgment call. Intermediate cuts are very rare. Let me put it that way. So that cannot be the base case right now. But if financial conditions deteriorate, particularly in the form of liquidity in credit, that's something I've my eyeballs on. Liquidity in credit, liquidity in treasuries. We saw a very violent move on Friday. If we see a couple more sessions like that, then Fed participation in markets, I think, becomes quite important.
But it hasn't been credit leading the risk off. It's been equities, it's been bonds being bid. Does that give you any comfort? Because past times we've seen this market action, it's been credit that screams for some while until the rest of the market realizes.
Yeah, look, I think the credit picture this entire year has been very positive. It's been a very low volatility part of the market. It has not responded to some of the ups and downs in inflation that we saw in the first quarter of this year. It really reflects the fact that underlying fundamentals on the corporate credit side are really good. But at this stage, we've priced in a very good story for credit going forward. And we're at a point where we could see that get infected from what we're seeing on the rates on the Treasury side.
So if that does happen and the Fed is forced to move because you do have that undue tightening in financial markets, and how convinced are you that this stops some of the unwind that we've seen? And it's not something that causes further panic, because we ask, what does the Fed know that we don't?
Yeah, it's a really difficult balance, because ultimately the mandate for the Fed is to reduce the risks to the real economy, right? Acting a little bit faster, I think, buys them insurance that the deterioration of the labor market that they're currently seeing isn't going to become more widespread, isn't going to accelerate into the end of the year and into next year. That's got to be the primary mission. The volatility in credit and equity markets is in many ways secondary to that. And from that perspective, I think the case for acting, whether it's an intermediate cut or just a more accelerated easing cycle than they've been signaling all year, the case for that, I think, is quite strong.
Ed, I was reading your notes, and I think you focused on something really important that I'd love to develop with you right here in this conversation: the difference between becoming less restrictive and becoming accommodative. How important do you think that discussion needs to be? How central should that conversation be going into that September meeting?
I mean, I think it's critical. It's part of the conversation they're going to have at Jackson Hole at the end of this month. That meeting is going to focus, or that conference is going to focus on the efficacy of the monetary policy transmission. From my perspective, monetary policy has been quite effective, and the risks are, at the moment, is that it's been too effective, given the slowdown in the labor market that we're seeing unfold. right now. And the conversation around taking monetary policy into more accommodative territory has to start this year, in my mind.
Ed, forgive me for asking for a number again, but what kind of levels are you thinking about in terms of interest rates this year? What would that be, down in the low threes to become accommodative?
I think we have to put Fed funds on a trajectory to about 3.5. That to me is a really nice rough bogey. At the moment, markets are pricing the Fed funds to come in about 100 basis points below the dots for both 24 and 25 in terms of what the Fed's forecast made in June. I think that's appropriate. The risks, in my mind, are skewed towards the Fed having to do a little bit more and front load that cycle to stabilize the outlook. So the more insurance you take out by front loading that easing cycle, the more room you have, I think, to take stock of the data at some point next year.
Interesting. Ed, enjoyed this. Thank you, sir. Ed Howard-Seni there of Columbia Threadneedle on the need to get accommodative at this Federal Reserve and get accommodative quickly. And we're going to have different opinions out there, but that's certainly in line with the direction of travel in this market over the last few days.
It definitely is. But if you look at other central banks who were accommodative quickly, it didn't help them today. The ECB cut in advance, the BOE cut last week, and still you see bond market rallies there. Still you see a market that's pushing them to cut even more. Still their equity markets are falling. So on a day like today, is having a more accommodative Fed enough?
Brutal morning, brutal session so far. Let's see if it changes. We just took out the low on equity futures on the S&P 500. For the session, we're down by 3.4% on the S&P 500. The rally in bonds continues at the front end of the curve on a 2-year. We're dropping by about 15 basis points. The yield there at about 373. On a 10-year, we're down about 7 or 8 basis points to about 371, 372 on 10. Some big moves, wild moves, in fact, in foreign exchange. Dollar-yen at the moment lower again for a 5th consecutive session on dollar-yen. We're down 2.6% to about 142. Coming up in the next hour, the third hour of Bloomberg Surveillance coming right up with Lindsay Rosner of Goldman Sachs Asset Management, Dan Ives of Wedbush, Andrew Hollenhorst of Citi looking for a 50 basis point cut in September, and he'll catch up with Stephen Stanley of Santander. All of that still to come. Up next.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Generative AI is one of these themes that has durability.
What have we heard this earnings season is that CapEx continues to go higher. We want to be positioned in those enablers.
Is there overinvestment in any sector? Not really. Corporate balance sheets look healthy. So, which is why I think we're still in a soft landing.
We would consider kind of fading the rotation and continuing to emphasize higher quality stocks.
I don't necessarily see this huge and strong rally between here and year end.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Your opening bell is 90 minutes away. Live from New York City this morning. Good morning, good morning. Here's your price action. Session lows on the S&P 500. We're down across the board. Here's the board. On the S&P, down by more than 3%. On the NASDAQ, down by almost 5%. On a Russell, down by 4.4%. We've talked about some single names. We've picked out big tech, some of the big players on Wall Street. Let's go to the tech names again. Look at NVIDIA, down by almost 13%. On Apple, down by almost 8 percentage points. And check out the rally in the bond market because it continues. The two-year yield dropped last week by 50 basis points. We're down another 15 in today's session, 372.75. I've said a number of times this morning, we need to take a giant step back. Just think about where we've been and talk about where we are now, where we've been. I used this quote a little bit earlier this morning from Chairman Powell. Sintra, Portugal, July 2nd. It reads as follows. Because the US economy is strong and the labor market is strong, we have the ability to take our time and get this right. Have they run out of time? Have things changed that much in a single month? There's a payrolls report that shows 114,000 payrolls and an unemployment rate of 4.3%. Changed the game that much. The market seems to think so. We're going to get into that this hour. I want to talk about the week ahead and how much things could change again potentially and go to two data points for you. The ISM a little bit later this morning at 10 a.m. Eastern time. Then later on in the week, jobless claims. And Danny, there's a reason we keep going back to ISM services because much of this started on Thursday with jobless claims and ISM manufacturing spooking this market. This market was already spooked, was even more spooked on Friday morning. Where are we going to be a little bit later this morning?
Well, part of it is a market that's run away with itself, that maybe it started with the economic weakness and the data coming in, but now it's transformed into something else. It's transformed into all these longs and short in the case of the yen that are getting unwound, and so the economic data won't make a difference. We're talking to Sarah Hunt of Alpine Saxo Wood earlier, who said that it would help, but it's not going to stop things. It won't act as a circuit breaker, and I think the question needs to keep being asked this morning, what can act as a circuit breaker? Is it the Fed doing emergency cut? Is it just these trades running out of steam? Nothing really seems so apparent at this moment of what stops it.
Let's talk about some of these trades. Japan is blaming the United States. We've got traders in the US blaming Japan. There's this feedback loop going on right now between dollar yen and what's developing in Japanese equities. Just to bring up the board again if we can. The Nikkei 225, if you've missed this, I don't know where you've been, but if you've missed this, I'll show you what happened overnight. The close on the Nikkei 225, negative 12.4%. Now, if you'd asked me on Friday, have we exhausted this move? Going into payrolls, I think pretty extended. We've unwound a lot of it. Then you've got another 2.8% percentage point move on dollar yen. on the session so far. These moves continue, and they're equally as vicious this morning as they were last week.
Yeah, if you were wondering what it was like to trade in 1987, if you weren't before, you're getting a taste of it this morning. That's how bad the sell-off has been. But again, it gets back to this point of feedback loops. Are we in this position where you get strengthening of the yen, so you get risk off, and therefore you get people going into bonds that shrinks the differential between the US and Japan, which then again just appreciates the yen, and it goes back and back around on itself. That's what makes this so hard to step out in front of. Even if you have a fundamental view that tech is a good buy, that we're not going into a recession, and the yen shouldn't be appreciating as much as it is, it's hard to make the case that now is the time to put on that trade.
This feels like a freight train over the last week or so, and it's a freight train, as Danny suggests, a lot of people don't want to step in front of. Coming up this hour, the lineup looks like this. We'll catch up with Lindsay Rosner of Goldman Sachs Asset Management. Traders raise bets on an emergency Fed rate cut, which I have to say, a lot of people on this program this morning have poured some freezing cold water over. Dan Ives of Wedbush will be joining us, looking at some of these moves in big tech and why he thinks there's a buying opportunity here. And Andrew Honhorse of Citi expecting the Fed to start cutting interest rates by 50 basis points in September. We begin with the big issue. Global stocks selling off as investors boost the odds of an emergency Fed rate cut. Lindsay Rosner of Goldman Sachs Asset Management with this to say. The market has swung too far to fearing a growth shock and a hard landing. One payroll report and higher tick up in the unemployment report does not mean that the Fed no longer has the will or ability to help via the monetary policy channel. We are starting to dip our toe into adding risk. Lindsay joins us now for more. Lindsay, we can take a breath here. I've said a few times this morning, it feels breathless in financial markets, and I think you're the perfect guest just to sort of work through this methodically and with purpose. Let's start with the data on Friday, then we'll get to the market call. Why are you so unconvinced by the growth scare that developed off the back of the data last week?
So I think what's important is we're not scared or unconvinced with what we saw on Friday. What we do think, though, is it is a data point. It's certainly showing labor market weakness or softness, but we've been in a trend of normalization, and you are going to have soft prints along the way. That is okay for the market. The fact that we have the VIX this morning at 50 on 114,000 payroll number on Friday, and an unemployment rate that's at 4.3%, which isn't terribly shocking in itself or a scary number, really still feels like an overreaction. Obviously, the market's reacting to the Somme rule being triggered and nervousness of what's happening in global markets, but it does feel to us to be a bit overdone. And again, Friday was one print, and we want to see more data to get a bigger picture. And most importantly, the Fed has the ability to cut. They have a significant amount of room if they are to cut. And so we are actually in a good place from a monetary policy perspective with room to run.
Let's turn to the market call. Starting to dip our toe into adding risk. Lindsay, just breathe some life into that call. What does that mean? Where would you like to add risk this morning?
Sure. So for us, as we spoke the last time I was on the show, we've been very low in terms of the spread risk we've carried in our active portfolios. And that's because spread valuations have been at the tightest levels of the past 10 to 15 years. We have been waiting for an opportunity for spreads to widen because we felt that prices or where assets were priced wasn't justified for us to have more risk on. Now that we've widened out a bit, we think it's time to start. We want to lean into high quality from the beginning. So whether that's investment grade, particularly I think it's in the US as opposed to Europe. And the other thing that we find interesting to watch but haven't found the right level yet would be high yield. In particular, the area of high yield that we have liked this year has been double Bs and single Bs. That has been the area that actually was close to unchanged on Friday. So we haven't seen move there yet. Today is obviously a different story, but it isn't about adding triple Cs. It's staying up in quality, whether that be investment grade or top of high yield.
Lindsay, I got to imagine there are a lot of people in your shoes who have said, I want to buy things like NVIDIA, I want to buy things like credit, but at these prices, it doesn't make sense. And all of a sudden, you get a window like today where the prices start to come back down to reality. But for a lot of those people, it's going to be frightening to jump in on a day like today where it's so negative. What do you make of sort of the timing of doing that? Do you want to jump in as soon as it starts to get bad, or do you need to see it play out more?
Well, I think it goes back to the principle of dollar cost averaging, right? That's the smartest way to play markets, whether it be equities or bonds. So it's not put all the chips in at this point in time because we're seeing 2 days of volatility. But it's starting, as I said before, to dip our toe. So we want to leg into opportunities as the prices make sense and spreads widen. Again, what's really important to us is taking a breather, as Jonathan suggested, looking at the big picture, and what are we actually seeing in the market? We're seeing corporations that are fundamentally in a strong spot. Balance sheets are still fine. We have no cliff of maturities. We are not seeing a default cycle pick up. We don't think a pronounced one is forthcoming. From an equity perspective, maybe a little bit overbought. We've now backed off from there. So the market is getting into a healthier zone, and markets don't move, even though I think we've been pretty used to it recently, in a straight line up. We have to understand that these kind of drawdowns and retracements happen, and this is why, from an active management seat where we are, we want to have the steady hands in the market to add where it makes sense.
One of the things, though, that we also had gotten used to, Lindsay, was just the huge growth numbers that some of these stocks were putting up. The Mag 7, NVIDIA, growing something like over 200% in a quarter when it comes to their earnings. I just got to wonder, given what we've seen so far from these hyperscalers, is it fair to say that that's also over, and that's part of the reason you see what you see today?
Well, let me give the caveat first that I am a bond girl, not an equity girl, but I'm happy to answer the question. So on the equity front, I mean, we all know, you can call it what you want. Is it AI euphoria or true excitement about what could potentially be a new industrial revolution? Now I think we're getting to the point that we've got to shift from excitement and just speaking about what's going on to seeing the data, seeing the output from companies. And I think that's some of the softness and the retracement that we're seeing in equities right now. We're in the stage of CapEx, right? So there has to be investment to be able to do all of this AI. As we have that investment, that can be a drag. And so the idea that we snap our fingers and AI works and every use case is happening in the here and now, that's just not how a new technology like this will work. And so I think the market has to have some patience. And again, the jitters around whether the Fed goes or whether AI is working today, I think we all need to calm down a bit and understand that this is a process and this is very natural for markets, whether that be new creative technologies or how we move from different parts of the economic cycle.
Lindsay, I just want to pick up on that word, process, and think about that September 18th Fed decision. Bit of a conversation around the table this morning about whether this Federal Reserve needs to get accommodative or just less restrictive. And as you know better than most, there is an important distinction between those two things. What are you expecting now? Alongside the team, what are you looking for in September and beyond?
Sure. So let me answer first. We're not expecting an emergency cut. The market right now, while maybe it doesn't feel great today, is not in emergency mode, and therefore it does not necessitate a Fed acting from an emergency perspective. September is not very far away, although we all are enjoying our summer. September is coming, and they will have the opportunity to do what they see fit. We think there's a decent likelihood for them to go 50. If you remember, obviously, on the way up in rates, we had a host of 75s and 50s. It's not strange to think that they could go more than 25. And I think as the data, and we will get 3 more important data prints between now and September 18th, let's see how they unfold, and the data will dictate whether or not the Fed goes 50 or 25. But in our mind, as we've been saying all year, they will be going in September. I think there is more of a decent probability now that they do in fact go 50 to kind of get us in the right motion and get things started. And really for us, that's the volatility we're seeing here. There's a baton being handed off. We're, to use a Olympic analogy, the baton was with the Fed thinking about, did they have enough confidence for understanding inflation was moving in the right direction? Now the baton has been handed to market participants who are trying to figure out, is the Fed going to react? And how significantly are they going to react? And in that kind of transfer of the baton, as it is in real life, it can be dropped. It can be shaky, and I think that's what we're seeing right now in the VIX and the move in spreads, and obviously the flight to quality rally as we're seeing in rates as well.
Cool, calm, and collected. This was perfect. Lindsay, it's good to catch up with you as always. Lindsay Rosner there of Goldman Sachs Asset Management. Want to keep going back to the calendar. To Lindsay's point about that baton being handed off and the focus now being on the labour market, much more so than inflation, given the recent print we've just had, the calendar looks like this. So August 14th, about a week away, CPI report. September 6th, another jobs report. September 11th, another CPI report. September 18th, the Federal Reserve decision. Now, as Lindsay says, it's just around the corner, but at the moment, looking at this price action, it does feel like a lifetime away.
Yeah, and if you have Fed officials coming out and still being calm, as they had. I mean, Goolsbee was talking to Mike McKee on Friday and was very calm.
Did not hear panic at all.
No, saying that this was one print, and we do not react to one print. But if it is in the market's hands, how much will it matter if we get more Fed speak out saying we are calm, this isn't the sky falling, things are okay? If the market is running away with this narrative, they might kind of need to change in order to calm the market. They might need to say, hey, look, we are ready to act because the market is doing what it is now.
Equity futures down by 3.7% on the S&P 500, a 2-year. This rally at the front end of the curve is picking up. The yield move we're now seeing is lower by 16 basis points on a 2-year. 372. What a move. What a move at the front end of this yield curve. Let's take an opportunity to get you up to speed on stories elsewhere with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Israel is bracing for possible attacks from Iran and regional militias following the assassinations of Hamas and Hezbollah leaders last week. Prime Minister Benjamin Netanyahu saying over the weekend his country is in a, quote, multi-front war against Iran's axis of evil. Amid the escalating tensions, the U.S. is moving a fighter jet squadron to the region and keeping an aircraft carrier nearby to help Israel. Still, the White House is urging Netanyahu to redouble ceasefire negotiations with Hamas. Vice President Kamala Harris is expected to announce her running mate very soon. According to people familiar, the vice president met with at least 3 possible running mates yesterday. Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Other possible choices include Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker. Harris plans to kick off a tour of 7 battleground states tomorrow in Philadelphia, and her running mate is expected to join her. And Hurricane Debbie made landfall in the Big Bend region of Florida earlier this morning as a Category 1 storm. The National Hurricane Center said heavy rain and powerful winds could create storm surges topping 10 feet in areas north of Tampa Bay and into the Panhandle. Coastal Georgia and South Carolina could see as much as 30 inches of rain beginning Tuesday as the storm slows and moves east over Florida. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, check out the price action and catch up with this guy right here, Dan Ives of Wedbush, on the tech sell-off and why he thinks, as you might have guessed, this is a big opportunity. That conversation is up next, live from New York. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This just in this morning, Mike Wilson, Morgan Stanley. The bottom line is that the consumer has been weakening this year. The risk-reward for equities broadly remains unfavorable at this stage. He goes on to say it's hard to argue that many stocks are cheap if earnings revisions don't turn around in a definitive manner. The latest call from Morgan Stanley this morning. Let's turn to the price action. It's not pretty. We're down by almost 4% on the S&P 500. The move in bonds continues. Yields are lower by 9 basis points on a 10-year to 369.50 on a 2-year. Check out this, Danny. The 2 years now down by 18 basis points. 370 on twos.
And it means we're just about a basis point away from the yield curve uninverting. And look, on a day like today, when you get this liquidity squeeze, it's really hard to grasp onto reality of what actually makes sense in this market. Does it make sense to price in an emergency cut? But again, just because the price moves are unreasonable doesn't mean that they can't become reasonable because of a feedback loop that could emerge.
Everyone's got an opinion right now, of course, and there are many, but this just feels like it's taken on a life of its own this morning. Let's see if it changes later on when we get that ISM print at 10 a.m. Eastern Time. Let's get you some morning calls. First up, Morgan Stanley lowering its price target on Disney to 110 from 130 and keeping an overweight rating. The firm taking a more cautious view of Disney's parks business in fiscal year 25. That stock is lower by 3.6%. Next up, JP Morgan lowering its price target on Target to 153 from 165, keeping a neutral rating on the shares. The analyst saying the boiling of the frog consumer backdrop continues. The water's heating up. Doesn't sound good. Stock's down 2%. And finally, Bank of America maintaining a buy rating on shares of NVIDIA and keeping the company as its top sector pick ahead of its earnings on August 28. The analyst saying any sell-off is an enhanced buying opportunity. That stock now, in the pre-market, on the session, is down 14%. Dan Ives of Wedbush agrees. It's a buying opportunity. He says this: we're getting inbounds from investors asking us if this tech bull market is over. It's not in our view. This is just a white-knuckle moment in a multi-year bull run for tech stocks that needs hand-holding. Dan, I imagine you're going to give some hand-holding right now. Dan Ives of Wedbush joins us from Japan, of all places. Dan, let's talk about this a little bit more. Why do you think this is a buying opportunity, and what would convince you, sir, to change your mind?
Look, this is the biggest test that we've had clearly in this tech bull market. And I think in terms of what I would need to see to be less bullish, do we see fundamental breakdowns? Now, we didn't see it from earnings. We're not seeing it from our checks in Asia. We're not seeing it in terms of what the demand outlook looks over the next 6, 9, 12 months. And as long as that stays, that's why I believe it's a buying opportunity for the high-quality, large-cap names that we like to buy in these types of periods.
Dan, you're talking about product and services. You're in Asia. I want to know who's been buying the stock and what they've been leveraged to. How much of this tech trade was leveraged to what's been developing in dollar-yen for much of the last year? How much do those two things have in common as they unwind before our eyes this morning?
Well, I think there's definitely, a lot in common. I think we're seeing that unwind today. I mean, look, here in Tokyo, clearly a lot of nerves, that we're seeing in this market, and we're going to see the ripple effect in tech. Now, in terms of what that means for tech stocks going forward, my view is that fundamentally, this is a once in a 40-year cycle in terms of where we see this AI revolution playing out. Now, obviously, these stocks are going to get crushed. When I look at names like Microsoft, you look at names like Oracle, NVIDIA, Palo Alto, of course, Apple, Tesla and others, for the high quality names that I believe the thesis is there, you own them and that sort of, and I would just say in 24 years covering tech, these types of panic periods, the hand holding, that's proven to ultimately be, I think, the right course for those types of names.
Dan, the lead in to today, though, did see what some have categorized as a sentiment shift. That the bar has changed for these AI names, that you can't just promise that you're going to see monetization. You need to deliver. And that sentiment change has also been highlighted by someone like an Elliott Management saying that they don't believe in the hype of AI, that it's not going to be as successful that many people think. I know you believe in the fundamental story, but if the sentiment has changed, How challenging does that make it to just be a bull and hold on to it through this bumpy period?
Yeah, I mean, look, I'd say the conversations over the weekend and today, it's a lot more nerve-wracking than it was even 2 weeks ago. And I think going through that period, it's a sort of not just talk, it's walk. Show me the results, show me the numbers. Now, look, those that did, a ServiceNow, I'd say maybe Microsoft second half growth, Apple, and despite what we saw with Buffett over the weekend, I mean, those are names rewarded. But now this is going to be a prove me moment for tech. Next 6 to 9 months to show those results, because in this type of market, in this type of risk off, clearly investors are going to head for the elevators with any sort of sniff of bad news.
Well, then it's going to make a lot of people feel uncomfortable that they have to wait until the 28th of this month to hear from NVIDIA. Dan, just what is the bar for them?
I think the bar's actually come down a lot over the last few weeks. But I can tell you what I see here in Asia and what we've seen from a demand perspective, there's no change. I mean, demand has not been the issue. And as long as enterprises continue to line up for AI, and look, we saw Lisa Su and AMD where they're starting to gain more and more share on that front, then this story will stay well intact. But just like we saw with Microsoft going into these numbers, going into this NVIDIA print, I mean, this is going to be probably one of the most watched prints probably in a decade relative to the nervousness that we're seeing in between these Fed meetings.
Dan, I noticed the beige. I was looking for black. I've got the suit ready for you when you get back to New York, okay? See if things turn around. Dan Ives of Wedbush, just a little bit more somber over in Tokyo, Japan. Just I'm talking about the clothing there. Bit of a difference in the conversation that you're having and the conversation he's having. He's talking about earnings, you're talking about multiples.
Yes.
There's a big difference this morning.
There is a big difference, and that's part of the reason why you can say, the fundamentals are great, the stock is really attractive, but you can still sell the thing just because people have been trading on more of a vibe than an actual tangible thing that these companies are delivering. And if the sentiment has actually changed and we're not willing to wait for companies, it's a little bit harder to say, I'm willing to buy these things on crazy high valuations.
Futures right now, session lows. We're negative on the S&P by 4.5%. The opening bell about 1 hour away. In just a moment, we'll catch up with Andrew Holmhorst of Citi, making some headlines almost straight away on Friday after that payrolls number dropped. Andrew publishes a call for a 50 basis point reduction in September. Stephen Stanley taking the other side of this. That conversation up next.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Keep saying take a breath, but no one seems to be taking a breath. This sell-off continues. We're 60 minutes away from the opening bell. Just take a snapshot of where equity futures are right now. We can just sit on it. We're down 4.5% on the S&P, down almost 6% on the NASDAQ. On the Russell, on the small caps, we're down by 5.5. A number of hours ago, Danny, I think people in Europe and Asia were thinking about the US coming in and buying this. It's not happening. It's getting sold.
It's certainly getting sold. The volatility story is getting worse. The VIX in literally just 15 minutes went from 50 to 60. Again, these are the kinds of trades where you picked up pennies in front of a steamroller, and this is what happens when the steamroller arrives.
It's a vicious unwind, just a vicious, vicious unwind of some big, big trades, including in Japan, which I'll get to in just a moment. I want to look at the 2-year and the 10-year, and we spent some time this morning looking at the difference between the two. The difference between the two was negative 50 basis points at the end of June, and now we're talking about a single basis point. We're down 10 basis points on 10s. We're down 18 basis points on a 2-year. We were down 50 basis points last week at the front end of the yield curve, and we wake up Monday morning buying even more of it. We're down aggressively at the front end of the curve.
We are, and it's kind of the only thing that works this morning, too, the only thing that you can kind of find safety in, and that's when you get to this thing of, is what I'm seeing in the front end of the curve some real signal that I need to take for where the Fed is going to go next? Or is it just the only thing I can buy is bonds this morning? So I have to pile into this trade if I want to see any sort of stability in my portfolio.
There are a lot of calls for some big moves from the Federal Reserve on September 18th. There is a 50 basis point call from Andrew Hollenhorst of Citi. We're going to get to him in just a moment. I want to turn to Japan. I mentioned that briefly. The moves we've seen in Japan, and I think the best way to frame this is think about everything that's happened since 1987. And if you've been around the market long enough, you can go through all of these events through the 90s into the 2000s over the last 20 years. Take your pick. We have just seen the biggest one-day move lower on the Nikkei 225 since 1987. We've had some big shots in markets over the last 30, 40 years. And here we are looking at this move right here.
So many people offsides on this one. So many people so bullish this market, so willing to short the yen. And so that's when you get a day where you have to start to talk about VAR shocks. You have to talk about positions getting cleared out. You have to talk about margin calls and that being part of the driver. So how much further can it go? Perhaps this is some of the weak short-term hands getting cleared out, but how many people are just structurally short the yen right now and it takes 1 month, 2 months to really understand your losses? Does that mean that we haven't seen the totality of the pain?
This relationship between the United States and Japan is just kind of one dimension of this overall market move, but it's interesting that the Japanese would be blaming the United States for the move that took place this morning, and the United States would be blaming the Japanese for some of the moves we're seeing in US tech stocks, and we've certainly seen Dan Ives establish that link from Wedbush. Others have done the same thing. Neil Dufter of Renmac, as you and I are speaking, writes in, what's funny about all this is that US yields led the move in JGBs. I'm not sure Japan is the issue. It is the US. And there seems to be a big debate over that right now.
Yeah, but if it is the US, I mean, how does it stop? If we're talking about an emergency Fed cut, if we continue to see yields move lower, that's just going to, again, do this feedback loop where you see appreciation in the yen. So regardless of what side it is, you still have a BOJ that hiked. You still have a BOJ that wanted to see strengthening in the yen. I guess it's, I don't know, be careful of what you ask for.
If you're looking for a circuit breaker, look for some Fed speak. You get Mary Daly a little bit later on this morning from the San Francisco Fed. I have to say the schedule, the calendar for both the Fed speak and the data is really quite light. The one you're looking for is later this morning at 10 a.m. Eastern time when we look for ISM services. And then you've got to go to Thursday for jobless claims. We'll get to that in just a moment. Under surveillance this morning, Berkshire Hathaway slashing its stake in Apple by nearly 50%. Warren Buffett's Berkshire also paring back ownership of Bank of America last month. A second quarter selling spree in stocks, sending Buffett's cash pile to a record $276.9 billion US dollars. And I think the right question to ask this morning, Danny, is how much of that's being deployed over the last couple of days?
Yeah, I mean, if you're looking to deploy some cash, maybe today is the perfect day, or maybe it's a day where you just want to log off and go to the beach and close your eyes and see what happens in a week's time, because it could get worse from here. I mean, we've heard that from multiple people around this table, that you're not sure it's going to end. But again, for Warren Buffett, I mean, hats off to him. The timing is kind of impeccable.
As you speak, as you say that, there is someone sitting on a train right now, coming back from the Hamptons on Bloomberg Anywhere, listening to this. There's a lot of taps on the shoulder and a lot of get back to work.
Right. Or maybe just hop off on the train, get on the train that goes back to the Hamptons and just, you know, call in sick.
Yeah, good luck with that this week. Goldman Sachs and Jan Hatzius have this to say. They're lifting their recession odds on the United States, but maintain that the risk is limited. Hatzius and the team raising odds to 25% from 15, but adding the Fed has plenty of room to cut. Goldman's still calling for just 25 in September. Just 25 in September, and they're making the point that actually to call for the 50, you've got to wait until September 6th when you get the next payrolls report. You get another one like the one we just got, it looks like they're going to change their call.
They are very clear on that, as is the Fed. Austin Goolsbee saying that we don't react off of 1 month's data, that we need to see more evidence of a labor market slowing down. The market is not acting that way. 1 month has been enough for it because some of the trend points that way. So does the Fed speak need to change in tone? Does it need to change to one that sounds more accommodative, lest the market run away from it?
Mentioned that 2-year move a few times. That move's now 20 basis points lower on a 2-year, which is just wild given the move we've already seen on Friday, 369 at the front end of the curve. The calls on the Federal Reserve over the last few days have been wild as well. Traders have been boosting the odds of an emergency Fed rate cut within just 1 week. Friday's disappointing payroll print continuing to rally treasuries on fears the Fed is behind the curve. Joining us now is Andrew Hollenhorst of Citi and Stephen Stanley of Santander. Gents, it's great to catch up with you both. I want to come to you first, Andrew, because you're out with the big call on Friday, 50 basis points in September. Goldman's is sticking with 25. They think maybe you should wait for payrolls to come out for August in September. Why are they wrong? Why is it now the right time to make the call? Why are you so convinced by Friday's data?
Yeah, when we came out with the 50 basis point call for September, we also think they'll go 50 basis points again in November. That was just after the jobs report. And I think that the key thing in the jobs report is not that the unemployment rate rose to 4.3%. It's not 1 month of data. It's that we now have 4 consecutive months of the unemployment rate rising and accelerating. So if the Fed is trying to get a soft landing, you have a lot of momentum upwards in the unemployment rate that you need to stop. If you're trying to stop that kind of slowing momentum, that means rates should be down, maybe at neutral, maybe below neutral. Well, where's neutral from here? Most people would say at least 200 basis points below where we are. So 50 basis points in September is really just getting started. That's why we have 50 again in November. Base case, they don't do this emergency cut, but it's possible.
Possible? What would make it happen?
I think a further sell-off in risk assets and seeing that broaden, right? It can't just be about the tech sector. It has to be broad. It has to be in credit markets, seeing credit spreads widening, liquidity issues. Those are the kind of things that could get the Fed to move early.
Stephen, you're skeptical of that they could go 50, that they're more likely to go 25. Why?
Yeah, I think, well, first of all, I mean, the key thing for the Fed right now is inflation. And I don't think that we've gotten over the hump on inflation yet. We had 4 bad numbers. We've had 2 good numbers. I mean, I did my forecast last month for CPI, and I got 0.3 for the core CPI. I don't think the Fed's going to be cutting dramatically in that sort of an environment. I also don't think the economy's that weak. I mean, Andrew's right about the unemployment rate, but if you look at the totality of the labor market data, it's certainly not signaling that the unemployment rate is giving us an accurate signal of what's going on in the labor market.
But again, as Andrew says, if it's not the level, it's the trend. Is the trend not concerning? Is that not enough for the Fed to step in?
Well, again, I mean, look, the household survey is a very noisy set of data. It's a very small sample. If we were seeing a dramatic pickup in jobless claims, if the JOLTS data were supportive, if all the other survey data that we were seeing was supportive of a dramatic cut in or a dramatic weakening in the labor market, I'd be more convinced. But as it is, I see that as more, there's a lot of noise in that number in my view.
I want to pick up on your point on inflation. I think it's really important and it's hardly been talked about for the last few days. We've got the next print on August 14th. Peter Chi of Academy published this over the weekend, and he said if the Fed does anything that looks or smells like they're eager to embrace the Fed put, we would likely see inflation, starting with risk assets. They're caught between a rock and a hard place in terms of being able to be aggressive. Why do you disagree with that, Andrew? Why do you think they're not as constrained as perhaps Stephen and the likes of Peter Chi are suggesting?
There are medium-term concerns about inflation. I'm not discounting that at all. But in terms of the near term, you have financial conditions that are tightening right now, are tightening rapidly, even as we sit here. And if the Fed doesn't push against that tightening in financial conditions, you will actually end up slowing the U.S. economy by more. So what they're dealing with right now is risk management, where, yes, there's some concerns about inflation, but cutting rates now, if they cut 50 basis points in September, that's already priced into the market. That's not going to cause equity prices to rally. They need to over-deliver on what's priced at this point to get equity prices just to stop selling off.
This is where I'm a little bit confused. It was only a few months ago we had people asking whether we needed to hike again. How much of a clear sort of sight have you got on how tight we actually are right now? How do we know that we're as restrictive as you are making out we are?
I think the clearest evidence is from the labor market. That's been our guiding light throughout this cycle and continues to be. If you look at the JOLTS report, for instance, the hiring rate has just consistently been falling below pre-pandemic rates, falling now. If you look at the leisure and hospitality sector in the JOLTS survey, the hiring rate is the lowest we've ever seen outside of 2008. It's lower than it was in 2020. So it is harder to get a job at a restaurant right now than it's been in very deep recessions. That's telling us that we have some real softness there.
Check out this move in the bond market. We've been talking about it for a while. 2-year versus 10-year. The 2-year is down 23 basis points. The 10-year is down just 12. And look at the difference between the two. There is a positive sloping difference now on that yield curve. Danny, I haven't been able to say that for quite a while.
No.
The difference between the two is now positive, a single basis point.
And there have been so many people who have said that when this happens, this is the recession indicator, not the thing being negative, not it being inverted, that it's uninverting that finally causes the recession. Steve, do you want to take any indication from this at all?
I'd like to let the dust settle a little bit. It seems like not a good day to be taking your fundamental signals. No, I think to Jonathan's point before, I mean, what we really need right now is we need more data. And we do get the ISM non-manufacturing today. The consensus looks for it to bounce above 50. Boy, that would, I would imagine, change the way people were thinking at least a little bit.
Do you think it would put this story to bed? Because we said one of the problems with this week is that actually the calendar for the economic data is quite light. We've only really got 2 points to play with. One is the ISM at 10 and the other is jobless claims on Thursday. Is one strong ISM services print sufficient to put this to bed? Or do you think the mood this market's in will just ignore strength and embrace weakness for the rest of this month?
It seems like an awfully strong panic mode this morning, so I don't know. Maybe. We'll see.
Andrew, this is tough, and I think this is what everyone's got to sort of embrace and confront right now through the next couple of hours and through this week. How sensitive this market will be to incoming data, strong data, and weak data alike.
It's a really difficult moment. It's a really difficult moment for the Fed. Danny said it earlier. You have the market that started responding to the economy. Now you're going to have the economy that's responding to the market. As these financial conditions tighten, it actually raises further the probability that we're in a recession right now or that we'll soon be in a recession.
Could we get an intermeeting cut then if this thing kind of snowballs?
That's the question. I think you do need to see more here. I don't think this is enough for an intermeeting cut, but that has to be something we put some probability on at this point.
Stephen, any probability of that for you?
Not unless the world absolutely falls apart.
You're not impressed by these calls at all, are you? You really think this is just a panic that could be over pretty quickly? That's what it sounds like. Is that a fair sort of characterization?
Yeah. Yeah. I mean, look, the Fed is going to be easing soon. In my mind, you know, more likely than not now September rather than November. But and I think once they start to go, they're probably going to be going in a series of moves. But I just don't see the need for a kind of a panicked rush.
Would they still call this a mid-cycle adjustment, do you think? Or would they tell us they're on the path to normalizing, on the path to getting accommodative?
I think it's a path to normalization, but whether that leads ultimately to accommodative or not, I think remains to be seen.
Andrew, how do you think they'll frame things?
I think I agree with Stephen there that they will see this as the need to normalize policy rates. At least that will be the first move here. Now, it might move to a need to move to accommodative. We've heard from Chair Powell, they think rates are restrictive here. And I guess that's my broader point this morning. Why would you be restrictive when the equity market is selling off and the unemployment rate is rising? You wouldn't be, so they'll be looking pretty quickly to move rates down towards at least 3%.
But if we want to live with the philosophy, if the Fed should do the least damage in this scenario, is hiking aggressively or before September not doing damage in terms of them signaling we're worried about something, that there is an emergency?
Yeah, I think that's exactly what they need to negotiate here. And I think you heard that tension from Chicago Fed President Goolsbee on Friday, not wanting to sound like they're over-responding, not wanting to spook the market further. But the reality is the sentiment is shifting, and it has shifted, and they'll have to respond to that.
But see, Stephen, that's why I wondered, to your point, why there can't be something bigger, because it feeds back on itself, and you get that negative wealth effect. You get conditions tightening, maybe more than they should, which gets a bigger reaction from the Fed.
Yeah, well, I mean, this has been one of the problems for the Fed all through this cycle, is that financial conditions have been easy, right? I mean, they raise rates, they talk about how policy is restrictive, but if you look at broader financial conditions indices, they've all been very easy up until, the last few days, and now we have to weigh, deterioration in risk assets versus the big rally that we're seeing in interest rates. So I think they're certainly cognizant of that, but I think the underpinnings for the economy are still pretty solid. And the one problem that this economy has, conceivably, is that Fed policy is super tight, and that's something that's very easy to fix. So we'll just see whether that comes fast or slow.
As of last week, Chairman Powell agreed with you. I just wonder how much has changed since Friday. Andrew, do you think if they had that information to hand on Wednesday, we would have seen a different decision?
Yeah, I think we would have seen a cut on Wednesday if they knew this was going to be the jobs report.
Amazing. Andrew, thank you, sir. Andrew Honhorst of Citi, Stephen Stanley of Santander. To the two of you, thank you. I just want to get you an update on some of the price action as we sort of guide you towards the opening bell, which starts in about 45 minutes to kick off another week of price action. I want to actually start in the bond market, not in equities. Bonds here, yields are lowered by more than 20 basis points on a 2-year at 366, on a 10-year at 368. So we actually have a 2-year below a 10-year for the first time since the summer of 2022. That is quite a change, and that is quite a rally at the front end of the yield curve. As we talk about bonds, equities are near session lows on the S&P 500, down by more than 4 full percentage points on the S&P. So if you thought that was over on Friday, you're waking up this morning scratching your head, and you've got a big headache. This is a big move.
And I think you put it so well that during the Asia trade, people were waiting for Europe to come online and then the US to come online and save something. Instead, what you got was a more than 12 percentage point drop in Japanese equities, the biggest since 1987. I think we're just grappling with the side effects of that, of how many trades were stacked on top of each other, how many trades really were contingent on a weaker yen that now have to undo themselves. And again, it just keeps bleeding through globally, markets, be it again, Asia, or here in the U.S.
The Fed is not willing to step in at this point, based on the officials we've heard so far from. We heard from Austin Goolsbee of the Chicago Fed. Mike McKee sat down with Goolsbee on Friday. Goolsbee basically said, give me more data. Give me more data. I'm not ready to make any assumptions about what we do come September. He implied they reduce interest rates, but there's none of that panic in their voices compared to, and I will use this word, the P word, compared to the panic we're seeing in the bond market.
Right. Well, you have a market pricing in an emergency cut. There needs to be an emergency for there to be an emergency cut. What's the emergency this morning? Equities selling off some 5%. It's hard to argue that that's enough for them. It needs to be something bigger.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakes. Hey, Yahara.
Hi, John. Oil is following equities lower, extending its losses to a new 7-month low. West Texas Intermediate is trading around $72 a barrel, while Brent futures are trading below $76 a barrel, erasing this year's gains. This coming as the market braces for a possible attack from Iran and regional militias against Israel in retaliation for assassinations of Hezbollah and Hamas officials last week. We're also seeing cryptocurrencies getting crushed. Bitcoin dipped below 50,000 earlier this morning. The drop adds to a 13.1% drop last week. That was the worst since the period when the FTX exchange imploded. Meanwhile, spot Bitcoin ETFs suffered their largest outflows in about 3 months on Friday. And U.S. candy giant Mars is considering buying snack maker Kellanova in what could be one of the biggest deals in the consumer industry this year. That's according to people familiar with the talks. Kellanova spun off from Kellogg last year as part of a restructuring and includes brands like Pringles, Cheez-It, and Pop-Tarts. The deal would link those brands with Mars staples like Snickers, M&Ms, and Skittles. Kellanova shares have gained over 12% this year, with the company valued at over $21 billion. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thank you very much. Up next on the program, we'll set you up for the week ahead and the day ahead as well. That's up next. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So the opening bound's about 40 minutes away. Price action, there's a lot of it. Let's get to equities first. On the S&P 500, down by more than 4 percentage points. Not a typo. Doesn't need correcting. That's where the market is right now. In the bond market, yields are lower by 11 basis points on a 10-year to 3.69. On a 2-year, down more than 20 to 3.67. Just unbelievable price action. I would like to get you the trading diary, just a flavour of the day to the earnings and the Fed speak for the week ahead. And we'll start with 10 a.m. Eastern time. In 1 hour, 10 minutes time, the ISM services data, one of the biggest data points of the week. That is the one to watch right now. How vulnerable is this market to getting whipsawed in the other direction? Or will it just be reinforced by weaker data all over again? Look out for that. Plus, we get some Fed speak picking up with San Francisco Fed President Mary Daly. Tuesday, U.S. trade balance plus results from Uber and Rivian. On Wednesday, more earnings from Disney, Warner Brothers Discovery, and Lyft. Thursday, your next big data point, another round of jobless claims. Plus, more Fed speak from Richmond Fed President Tom Barkin. Mike joins us for more. To break this down, Mike McKee, we are light on data, we are light on Fed speak, but let's talk about the data that we will be getting that we do have. ISM services at 10 a.m. Eastern. Given where this market has been and given what it's doing, how important is that data point going to be?
It's going to be very important psychologically, if nothing else. If we got a bad number, if it's still contraction, we had the first contraction in ISM services in months for last month. If we get another contraction, then people are going to be, you know, opening up the windows down on Wall Street and ready to jump out today. We'll look at the underlying numbers as well and see what it says about employment, and if that backs up the idea that the labor market is falling apart. Then you got to wait till jobless claims. I mean, that's going to be the only other number that's going to matter this week, and we know July is often distorted by seasonal adjustment factors, so it could go either way. They could fall. If they fall, then everybody who is jumping out the windows is going to be reaching for a parachute.
Mike McKee, you heard from Andrew Hoddenhorst, he's looking at 50 September. Mike Ferroli, JP Morgan, looking for 50 September. I'm sure there's another part of this conversation that's bugging you a little bit. The intermeeting calls.
Yeah.
An emergency rate cut from the Federal Reserve. You've been around the Federal Reserve a long, long time. When you see those things coming up in markets, what's your reaction to it?
The Fed doesn't cut rates because stocks fall. The Fed does emergency moves when the stock market ceases to function or the bond market ceases to function, when people can't make trades. And right now, there's no sign of that. They're not going to worry about the fact that you're losing money because maybe you got out over your skis somehow. Danny put it very well earlier about, the Fed would cut rates in an emergency, but what's the emergency here? It's 1.5 days of bad equity performance. There's a lot of signs that things could get better from this, in the sense that, yes, you balance off the wealth effect, but you also have gasoline prices falling, you have mortgage rates falling, you have some stimulus in the markets already from the reaction to all of this. So the Fed has to weigh all of that, and they don't want to get back into the business of these emergency cuts and going back to zero in the Fed put.
Just to that point, you spoke to Austin Goolsbee on Friday, a very calm Goolsbee, talking about it's just 1 month. We need to see more months. Is there any sense that a market overreaction could change that kind of calm tone from the Fed?
It would have to be sustained, and it would have to be, really deep and really threaten a wealth effect issue or threaten corporate confidence so that companies want to start laying off people. Recessions are really psychological events, and we haven't seen that from anybody but the equity investors at the moment. If it spreads to a broader economy, then the Fed might want to do something like that. But they're going to wait and see. As somebody pointed out this morning, in January, we were pricing in 6 rate cuts.
Yep.
Now we're pricing in 6 rate cuts again. The Fed has not changed its view pretty much for the whole year.
Markets change a lot.
The markets change all the time.
Danny asked the question earlier. I think it's the right question. It's a really good question about the labour market. Weather. We were really surprised on Friday to see it sort of explicitly mentioned that this wasn't about Hurricane Beryl on Friday. Where are you on that? Just how weather impacted this labour market, or rather how weather didn't impact this labour market?
Well, somehow weather impacted the labor market. Whether it was the hurricane or not, we don't know. There were over 400,000 people who couldn't go to work because of weather, which, if you added that back in, obviously would have made the numbers a whole lot different. A lot of people working part-time because of weather. The BLS says it wasn't because of the hurricane. We don't have any data that would argue with it. In the middle of the month, we'll get the Texas unemployment figures for the month, and we'll see if they bear that out. But at this point, there's a very good chance we could see a snapback in the August numbers when we get them at the beginning of September, which is another reason the Fed doesn't want to panic. And remember that the error band for jobs is 130,000. So this could be, a negative. July could have been a negative number, or it could have been over 200,000.
We'll see where we are this time tomorrow morning, and tomorrow morning feels like a long, long way away. 10 a.m. Eastern Time, so next stop for this market, ISM Services. That is a big, big data point, about 1 hour and 4 minutes away. Equity futures session lows, your lineup tomorrow. Katie Kaminsky of Alpha Simplex, Jim Karen of Morgan Stanley, Tim Tsouras of Strategas, Christina Kampmanny of Invesco from New York City. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
We have seen the biggest drop in futures since the COVID pandemic began. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a manic Monday for markets. The global sell-off is intensifying with the NASDAQ 100 set for its biggest opening drop in more than 4 years.
Overnight in Asia, Japanese stocks had their worst day since 1987, with both the Topix and the Nikkei entering bear markets while the yen surges on the unwinding of carry trades.
And as investors weigh an emergency Fed rate cut, Goldman economists raised their odds for a U.S. recession in the next year to 25% from 15%. Let's take a look at where markets are trading right now because it is dramatic on this screen behind me. You can see the S&P 500 currently down by about 4% pre-market, even more so if you take a look at the NASDAQ 100. Your big tech stocks really bearing the brunt of this potentially as people unwind some of their winning positions. And the Russell 2000 down about 5% as well. Let's take a look at the VIX, though, because you can really see the volatility in action right now. The VIX on the left of that screen right there, maybe the right for you, currently trading at about 60 right now. For context, we got to 80 during the real throes of the COVID crash. So we'll keep an eye on this one, Matt. Obviously, some big moves underway.
Yeah, only the third time we've seen a level that high since the 90s. Take a look at the SOM rule. This isn't a recession indicator that has been on the money since at least the 60s. Every time the 3-month average of unemployment goes and adds 50 basis points, we have a recession. That's happened for the last 9 recessions. It's happened again with the jobs number on Friday. So if we're not in a recession, it's the first time that this has happened without being in a recession in about 70 years. Also, take a look at the gap between the 2-year rate and the Fed funds rate. It has dropped to almost 200 basis points. It's also been a really good recession indicator going back to the 60s, and it's the biggest drop that we've seen, or the biggest spread in this rate series since 2008, since the great financial crisis.
Bond market volatility, index level volatility, and certainly stock level volatility. Of course, we're keeping an eye on Apple this morning, down more than 9.8% pre-market. Remember, that also has Berkshire Hathaway cutting its stake in one of its largest holdings. Amazon.com also down 8.6% this morning. Tesla down 9.4%. Want to flip up the board here and take a look at some of the other big trades. Remember, this was a market levered long on the technology industry and the Magnificent Seven, but certainly also the darlings of the industry taking a massive beating this morning. Matt, you look at NVIDIA down more than 12%, Intel down more than 6%. A lot of pain when you look at the semis and chips.
Yeah, I have to say, I went to Spain on Wednesday, and I was already surprised that the market was up in that session because you had the killing of the Hamas leader in Tehran. I thought geopolitical tensions would spur their ugly heads. Plus, you had the yen starting to climb, but it wasn't really until the non-farm payrolls number and this triggering of the SOM rule that markets really started to sell off in earnest.
Yeah, big time. It feels like things definitely took a different complexion this sell-off once you had that NFP report that was not great. It obviously missed expectations on the downside, but things really took on a different complexion than over the weekend with the unwind of that carry trade. Maybe as Asian investors had a chance to react to what we learned on Friday morning in the U.S.
And it's interesting. You now have many economists and traders seeking that inter-meeting rate cut, yet does the economic data really say so when so much of these market moves that you're seeing, guys, is based on that positioning that you had in markets, the unwinding of that carry trade as you're talking about, and systematic funds selling off. And by the way, when you put margin calls on top of that, you have to wonder how much pain there is to go.
All right, let's talk about this with Stuart Kaiser. He's head of U.S. equity trading strategy at Citi. And Stuart, it really, I think, looks like the recession fears, the growth fears spurred by the payrolls report is what kicked off this sell-off in stocks. Would you agree?
Yeah, I mean, I think that was a starting point. If you look at, how the market traded last week, you were up on FOMC day. The following day, you got that claims number was a little bit high. You got some internals to the ISM weren't great as well. And then you followed that up with a weak but not horrible jobs report. And, I think collectively what that did is it said, if you added up 3 or 4 data points, you'd throw ADP in there, you'd throw the employment cost index in there as well. You sort of had this massive data that suggested a relatively rapid loosening in the labor market. And our view has been you run long U.S. equity risk until that U.S. labor market comes under pressure. So that was the pressure point of the market in our view, and it has triggered a broader base selling. Whether it's all inflation, all recession fear is hard to tell, but that's been a key component of it.
And you listen to financial media this morning, you read through sell-side notes, you go on Twitter if you're that kind of person, and so many people are talking about the unwind of this yen carry trade. I'm hoping you can walk us through the steps there, sort of the daisy chain from I'm unwinding my yen carry trade right now to NVIDIA is down 12% pre-market.
Yeah, well, I think there's 2 aspects of the sell-off you could identify. One is if you're trading recession fears, that is broadly equity negative, and it's going to have much more pressure on domestically facing cyclicals. You put kind of IWM or small cap in that category. The yen carry trade would be more a positioning argument, right? So if you believe that the yen carry trade was happening, the question is where were those funds going? If those funds were coming into the U.S. and sitting in large cap U.S. tech growth stocks, then the unwinding of that just becomes a positioning pressure on the market, and that should be more acutely felt by effectively Qs and those large cap tech growth stocks. So I think if you're looking at the market today, you want to look at those 2 things. Does it look like the market's trading a recession and putting cyclicals under pressure, or does it look like the market is rotating? In which case you should have Qs underperforming IWM. In the recession area, you'd have Qs outperforming IWM.
I think what's discomforting here is not knowing where the bottom is right now. If you believe that the carry trade is part of this, then how far does that deleveraging go? Especially knowing that deleveraging is now becoming a broader problem. If you were levered long, you are feeling this today, and you're probably unwinding a bit more.
Yeah, I think, Sean, to your point, you don't unwind a trade you built in 2 years in a week, right? So if this is a true unwinding and you get that cascading effect, yeah, you still have room to go without a doubt, whether it's the yen carry trade or Qs. I mean, folks that are overweight NVIDIA didn't build that position in a week. They built that position over a couple of years. So you're not going to get out of it that quick. This would be a real test of retail. How devoted are they to the AI trade? And then secondly, to that institutional sponsorship of that AI trade, at what level do they say, I buy NVIDIA here because I need to own this for the next 3 to 5 years? And, we'll see. NVIDIA's held in relatively well the last couple of days, I think, given how high its beta is. But that'll be the test on the institutional side is what's your buy point and where is your kind of must-own level on some of these stocks?
I mean, the interesting thing is that some of these currents have been running for weeks, right? I mean, the yen has been strengthening since the beginning of July. So it's not like something that just happened last week. Also, Warren Buffett has been selling off huge stakes since I guess that time as well, right? He was selling Bank America, which he said is a stock that he could hold forever. He's been selling Apple like crazy. And if you're a retail investor looking at the Oracle of Omaha, this is like the guy behind the curtain, right? He's selling? This is the top. He's saying this is the top?
Yeah, but what I would say is during that period through July, you had kind of three distinct stages of this, right? You got the CPI print that was really light, and that triggered a soft landing trade. The soft landing trade, as I mentioned, is a rotation trade. You printed an all-time high on the S&P after that inflation print. So that was equities higher, rotating into cyclicals. You got the Google print. That created risk around what do I think the outlook for tech cap spending was. That was equities down. That wasn't equities up rotated. That was equities down. And now the third stage is you get this weaker sort of employment data, and now the market's trading a recessionary risk, right? And the question is, do you trade that as a pure recessionary trade, or is there an element of sort of position destruction that needs to happen alongside that? I actually think the equity markets have gotten it right in terms of how they've traded each stage of that. It does feel a little bit overdone, the degree to which the market is sort of chasing this recession.
But Stuart, do you not worry that Warren Buffett at Berkshire Hathaway is saying this is a great time to sell high and start to build up cash for when prices are much lower?
The top.
You know, look, he could be calling the top. Look, for me, no. Like, I'm not looking at Warren Buffett selling Apple and saying that that's necessarily the top of the market. If you look at how retail behavior has evolved over the years, retail behavior used to be more of a buy and hold. I'm gonna, you know, my grandkids are gonna inherit this stock. Now you have retail trading zero-date options, right? So the way retail trades has shifted, and it probably makes that kind of, you know, Warren Buffett sell signal a little less acutely painful than it would have been in the past.
We got to get to zero DTE, but we have to talk about the VIX first because it has just been dramatic watching it all morning. A little bit below 60 right now. It had spiked above 60. We're at levels that we haven't seen all that often in the past 3 decades. You think about some of the volatility tracking funds out there. You think about some of the inverse VIX ETFs that exist right now. They're smaller and theoretically safer than they were during Volmageddon in 2018, but does that give you any pause?
I mean, it gives me pause to see how much the VIX has moved. You know, I wouldn't have expected to be on a 60 handle this morning. You know, all of those they're all vol-related stories, and they all kind of fall in different categories. You might argue that this happening on a Monday is a positive in the sense that people didn't carry a lot of short vol over the weekend after what happened Friday. Zero-day trades, by their definition, are over at the end of the day. So if you're short a Monday zero-date option, you made that decision this morning. You know, so you're kind of not underwater in that trade. I would say though, to your point on the ETFs, there's a lot more structural selling of volatility going on over the last couple of years, whether that's through, you have one-day override ETFs, you have the buffer funds, you have a lot of, you know, QIS and structured products coming out. So yeah, it is a risk. I wouldn't put it in the Volmageddon category. I would put it honestly in a similar category they put the large cap tech, because these are accumulated positions over a period of time that kind of need to rebalance themselves.
Real quickly here, is this a drop in the bucket of VIX flirting with 60, or is this a signal to stop selling vol?
Well, look, it's going to be a signal to stop selling vol for a period of time, you know, because you're going to get a VAR shock that goes through, you know, PM's risk management systems. And that's how you get this cascading effect, right? So you get the initial move, and then, you know, risk managers tell you kind of need to, you know, pull risk in a little bit. So yeah, I think you'll get a little bit of a pause, but the bottom line is when people who are not getting burnt by the trade see a VIX at 60 and say, I want to be short that, because that, you know, that level is unsustainable. Vol is kind of a mean reverting asset.
No, absolutely. All right, Stuart, you're going to stick with us. We have more to talk about. Let's take a look at where futures are trading right now. Just about 20 minutes until the opening bell. You have S&P futures down 3.6%. NASDAQ futures off almost 5% right now. Same is true with the small caps.
All right, you take a look at some of the individual stocks moving underneath the market right now, and it's all the big ones. You have currently Tesla, Nvidia, and Apple seeing big declines there. You can see Tesla off by 9% pre-market. Nvidia actually leading losses right now, down 12%. We're talking about some of the biggest companies in the index, and of course, that's what's adding to that math there. Apple, this is one of the few stocks with a fundamental reason here. Of course, as Matt has been mentioning, Warren Buffett cutting that Apple stake by nearly half, just really adding to that sort of depressed sentiment. I think I'll call it that. This is Bloomberg.
themes that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. The race to be on the ticket with Vice President Kamala Harris is nearing the finish. The presumptive Democratic nominee met with a short list of 3 potential candidates yesterday: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Harris also spoke with some other contenders on the phone, and she's expected to announce her decision, well, tomorrow. The Prime Minister of Bangladesh, Sheikh Hasina, resigned after weeks of deadly protests saw about 200 people killed in July. The nation's army chief announced he would help form an interim government and had invited political leaders to meet today. Hasina had fled the country, or has fled the country. He's expected to be traveling now to London. And President Biden declared an emergency in Florida after Hurricane Debbie slammed into the area just southeast, I should say, of Tallahassee. The storm is the second Atlantic cyclone to hit the U.S. in 2024 after Beryl struck Texas last month and caused a massive power outage. More than 200,000 homes and businesses were without power this morning in Florida. Shonali?
And Matt, July's rise in unemployment triggering the SOM rule recession indicator. And the rule has a perfect track record, near perfect track record, over the past half century.
Perfect.
The woman behind the rule, Claudia Saum, joined Bloomberg this morning.
Calm is important in a moment like this, regardless of what indicator or data point you're looking at. You know, the fear does no good. And this, again, this was trying to give a simple summary of one piece of the U.S. economy. The labor market is very important. There's a lot of complications right now. Again, it's this balance between be calm, but take it seriously. Right? Like there is slowing in the U.S. economy, and we have seen that. The point is to keep that slowing from really pulling us in reverse. We're not there yet.
For more on recession calls, we are joined now by Michael McKee, Bloomberg's chief international economics and policy correspondent. You looked at the triggering of the SOM rule. You also looked at the steepening of the yield curve and the mild disinversion we've seen, at least for a moment. Michael McKee, what do you think this all means at the end of the day about the chances of a recession when the data is relatively strong but weakening? Where do you put it all?
Well, that's the thing, Shonali. It's relatively strong. It is weakening. The Fed expected it to weaken. Now, in the last week, we've had some signs that are a bit worrying, as Claudia was talking about. We had a weak ISM manufacturing number. We had a weaker than expected jobs number, although it wasn't all that bad. Jobless claims rose. That scared some people. The yield curve, as you mentioned, disinverting, and then we had some bad tech company earnings. Now, does that mean that we're going into recession? Not necessarily, because there's a lot of right things. I mean, so far this year, we're seeing the markets up, S&P and NASDAQ, up 12% each during the year to date. GDP stronger in the second quarter than it was in the first quarter. The Atlanta Fed GDP now is talking about 2.5% for the third quarter. The bond rally is stimulative. Mortgage rates have fallen significantly down to 673, and gasoline prices are falling right now. So there are offsets to the bad news, and the question is, do we see a recession? Well, it's hard to see from the NBER criteria. They're the recession arbiters, because they're all still rising, some more slowly than others, but in general, it would take a lot of reversals, a lot of revisions to these numbers to suggest that we're going to see a recession.
Yeah, and of course, Goldman out over the weekend, raising their odds, but still only 25% of a chance of a U.S. recession in the next year. Bloomberg's Mike McKee, happy Monday. Thank you so much. Citi's Stuart Kaiser still with us right now. So again, a lot of talk about September, but a lot of talk about an emergency Fed rate cut. Of course, Jeremy Siegel making waves this morning, calling for a 75 basis point emergency cut. Would that help anything?
I mean, you might get an initial bounce in equity markets, but it also sends, I think, a pretty negative sign to markets, because it suggests either A, the Fed is so worried about liquidity and functioning of the financial system that they need to cut aggressively, or they believe the economy is decelerating at such a rate that the Fed needs to cut that much. So I actually think the signaling, you might get a bounce in the markets, but I think the overall signaling that would send to risk assets would be a negative.
Dude, that would be like yelling fire in a crowded theater. If they come in with an emergency rate cut, it's already like insane before the next jobs number, September 6th, and then 75 basis points? I mean, who are we saving here, right? That's not going to change the economy on a dime. It takes, what are the long and varied lags, right? It's not like 2 minutes, it's 6 to 18 months.
Also just scream moral hazard here. At the end of the day, if we're talking about a generational unwind of a carry trade, what does it mean for a Fed to step into that kind of market?
Yeah, well, and that's my point. I mean, if they really think the unwinding of that trade is going to massively tighten financial conditions, that just sends a really bad message to risk assets. And Matt, that's why I always sit on an aisle seat near the exit, just in case this kind of stuff comes up. But yeah, Shanae, I don't believe the economic data we've seen over the last 2 weeks would justify an emergency cut. So if they're doing that, they are telling you they are,
purely reactionary.
Yes,
it sounds like.
Yeah, and also, or some people in the market will read it into they are seeing something that we are not, either through the access they have to bank funding and liquidity, or something on the data side.
Is this a start of a new paradigm to markets? You had a market levered long, as we've been saying, to Mag 7 names, to the semis. Do these trades start to, I mean, for the lack of better words, rotate? The rotation has looked different in the last couple of weeks, but has the market psychology changed?
I think it has. I mean, the first 6 months of the year and probably the last 12 months were really a higher for longer trade that was going through the system. That is evolving. And you're either getting into kind of a pure soft landing trade, which is kind of what you saw on July 11th with the CPI print, or you're trading, no, we're going to blow right through soft landing and go to hard landing, right? So I think what's changed is you've sort of, and PMs are having to evolve their portfolio out of a pure higher for longer into a, we're slowing growth a bit. Do I think that soft lands that I get insurance cuts, in which case I want to be long U.S. cyclicals and lower quality stocks, or I'm actually worried about this recessionary trade, which is obviously just a risk off, which is what we've seen the last couple of days.
Right. Well, going back to the concept of an emergency rate cut, or if the Fed does a supersized cut in September, 50 basis points or something along those lines, beyond just sentiment screaming fire in that crowded theater, I mean, what would that mean for the carry trade that we're talking about? Wouldn't that just exacerbate things?
Well, I mean, look, if you lower U.S. rates, then you have less rate differential globally, and I guess that might help. That actually would get, to your point, sort of force more people out of the carry trade to some degree. The question is, do you get enough support from risk sentiment and financial conditions to kind of balance that out? Look, if they cut 50 in September, which is what's priced, the reason for that is going to be dependent to what Matt said earlier on the data we see between now and then, right? If we get another friendly CPI print on the 14th, and then you get, let's say we print 150 to 200K jobs in early September, then a 50 basis point cut is read as insurance. And you're going to have equity markets respond very positively to that. If instead you print 0.2 on CPI, but you print sub 150 on that early September payrolls, that 50 basis points cut is going to be viewed as a necessary solution to an economy that's rapidly decelerating. Rate cuts in that case are not nearly enough to support equities, and equity markets will be lower in that scenario, I think.
All right, Stuart, thanks so much for joining us. Appreciate you coming in this morning. Stuart Kaiser there, head of U.S. equity trading strategy over at Citi. Let's check on futures again as we head into the market open. Just about 8 minutes until the bell rings. We see red arrows across the board, big, deep red arrows. In fact, This will be the worst open for the NASDAQ in 4 years. Since 2020, when we all went into lockdown, it's down 5%. The futures are down 5%. S&P futures are down almost as much, 3 2/3%. Take a look at what's going on with the 2-year. The massive move in the 2-year yield really was on Friday, right? Now we're at 372, and the spread between the 2-year and the Fed funds rate is the biggest it's been since 2008. Take a look at the SIBO VIX there, up at 55. It has been up at 65 earlier, and the Japanese yen continues to strengthen against the dollar, right now at 142, making that carry trade more and more painful. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, CrowdStrike says that Delta ignored an offer for assistance in the wake of last month's system outage that led to thousands of canceled flights. The carrier was the worst hit airline as it struggled to normalize flight operations several days after the outage. Delta considering legal action against CrowdStrike. Next up, the confectionery giant Mars said to be in advanced talks to buy Kellanova. It could be one of the biggest deals in the consumer space this year. Kellanova, remember, was spun off from Kellogg last year, and the acquisition may help Mars fight back against a weakening consumer. And finally, Tyson Foods feeling on top of the pecking order today after reporting earnings that topped estimates thanks to a rebound in its chicken business. Producers benefiting from lower corn and soybean prices, along with a resurgence in consumer demand for poultry. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now coming up, we have Crossmark's Victoria Fernandez saying to buckle in for a bumpy ride. She joins us for the market open next. This is Bloomberg.
you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Moments away from the start of trading on what is going to be a very dark Monday open. This is Bloomberg Open Interest. I'm Matt Miller. Look at futures down. The biggest drop that we've seen for NASDAQ futures since 2020, since economies around the world went into an actual lockdown. That's the last time we saw the NASDAQ open this deep in the red. The S&P 500 futures are also taking a big hit this morning, down almost 4%. Here at the New York Stock Exchange, we have TXNM Energy ringing the bell on a day they probably won't forget. Over at the NASDAQ, you've got Hancock Whitney ringing the opening bell. We are seeing big drops in the cash trade. It looks like even worse than futures. Let's get over to Katie Greifeld right now to see where we're moving. Katie?
Yeah, I'm excited to tell you about it because there's a lot of action to walk through right now. The S&P 500 down more than 4% just in the first few seconds of the trade. Even worse, if you take a look at the NASDAQ 100, your big tech names really bearing the brunt of this selling right now. Of course, a sell-off that started in Asia with Japanese equities continuing right now at the U.S. Open, and the small caps, too, really taking a bath here. The Russell 2000 down by more than 4%, nearing 5%. But one stock to watch at the open is Tyson, one of the few stocks in the green right now. That's after it posted an earnings beat as a rebound in chicken profits helped to offset a downturn in its beef business. You can see shares currently up 2.4%, Shanali.
Speaking of chicken, there's some chicken going on in the crypto market here. You have Bitcoin dropping below $50,000, and so we're keeping an eye on those crypto-related stocks. Coinbase down 20% at the open. Marathon Digital also in conjunction around 20%, nearly more than 19%. Riot Platforms, a miner here, down more than 14%. Pretty remarkable. Now watching crypto, Bitcoin really at a third of its March high, a third of its value wiped out, Matt.
All right, let's take a look at the big behemoths here. In terms of Apple, you know, after the sell-off news over the weekend, Warren Buffett reducing his stake by tens of billions of dollars. Let's take a look at where it's trading right now, as well as NVIDIA. Let's go ahead and bring them up. Or maybe I will on my terminal first here. Apple right now trading down about 8%. 8% is the drop in Apple 202. NVIDIA also trading down big, wiping off probably $300 billion in market cap. NVIDIA down 14% right now. Let's take a closer look at the big drop in the biggest tech stocks with Abigail Doolittle. Abby?
Yeah, Matt. Well, this sell-off that we're seeing in stocks, it's not entirely surprising. We've been looking at charts all year of the stock indexes, Bitcoin, and individual stocks, pointing to the idea that there could be some sort of a real sell-off. Apple, no exception. Warren Buffett's Berkshire Hathaway started selling last December. That was a big reason why the stock was in a bear market up until April. It really should never have gone back above 200. It's there now, but well off the highs, the worst day since March of 2020. NVIDIA, also the worst day since March 2020. Too far, too fast, the AI craze ahead of the selling in NVIDIA. The bear market that it's in, it had been up more than 180% on the year. Amazon down 7%. Even stocks like Palantir reporting after the bell down 13%. With this, we're of course seeing the spike in the fear index, or more accurately, the uncertainty index. This is a 5-day chart, and I know that you were talking about this with Stuart Kaiser, but take a look at the VIX flatlining around a 15 handle, sort of a complacent level from a historic standpoint, all the way up to a 65 essentially, now coming off this, but nonetheless the highest level since March of 2020. And if we can connect this back to Apple, the Apple chart strongly suggests we have more selling ahead. This is a long-term range where Apple's basically going through, let's call it 170 up toward 200. Take a look at the drop right down into the range, the bottom of this range at 170, the RSI going down. It suggests Apple's going to sell off by another, let's call it 15% or so. As one of the biggest stocks, this could be brutal for stocks. The index is ahead.
Certainly off of peak panic for the morning, but a brutal morning nonetheless. Abigail Doolittle, we thank you for your analysis, and joining us now for more analysis, Victoria Fernandez, Chief Market Strategist at Crossmark. You look at this market, Victoria, there's very few places to hide. You really see the brunt of that bid in the bond market, but gold is down, Bitcoin is down, stocks across every major indexes are down for the most part. How do you position in this environment right now?
Well, what we're hoping is that a lot of people have done what we did with our clients over the past couple of months when we were seeing some of the warning signs that we thought we would see a larger pullback in this market, and start doing that rotation out of the momentum trade, start trimming some of those tech names that you had such high positions in, getting some cash on the sidelines and finding those areas in the market that we thought would do better in a downturn. So we were looking at some of the staples names, some of the healthcare names, utility names. You know, we liked financials, but we said wait for a pullback because financials had such a strong run. And we're starting to see those trades now start to do better on a relative basis. So do you go in today? I'm not sure. I think you take a little bit of a break today with what we're seeing in the market. Let things settle out a little bit, and then start looking at some of those names that we mentioned, some of those more defensive, more staple plays in your portfolio, and building those up while trimming some of your other ones.
And Victoria, I do want to talk about what's going on right now, what's going on today, because it feels like we're still in diagnostics mode as to what is actually causing this massive sell-off that we're seeing right now. Of course, there's been a lot of talk about the carry trade unwinding, particularly those yen-funded carry trades. Just walk us through sort of, again, the chain of events there. What is actually fueling this sell-off, and where did it start?
There's definitely, I think, a culmination of events that came together at the end of last week. The market is not reacting this way because the non-farm payrolls came in 60,000 less than expected, right? But I think that was kind of the straw that broke the camel's back, in the sense that we look at earnings. I know earnings are up 11% year over year, but if you look across the board, you're not getting as strong of a guidance as people were hoping to see. So guidance is concerning regarding consumers. You were seeing yields already start to come down, not because inflation expectations were coming down, but because there were growth concerns coming down. You saw a lot of weakness in manufacturing and a lot of weakness in the labor market besides the payrolls number. You look at job openings, those were stagnating. You looked at quits, those were falling down. One of the most important recession indicators is really looking at the job differentials. Job plentiful minus jobs hard to get. It hit a cycle low. So there were a lot of elements churning under the surface that were telling us growth is going to be coming back. Jobs are not there, wages are not there, and that means trouble for the consumer. I think Friday, again, was a culmination of all of that. Add in the unwind of the carry trade that you were seeing as the Bank of Japan raised rates, and the expectation that we would be lowering rates in September after the Fed meeting. All of that coming together, I think the market came to realize, wait a minute, things maybe aren't as good as we thought. Maybe that soft landing is not a given. And that's why we're seeing the reactions we are. We also have geopolitical events going on that adds to the uncertainty.
Yeah, I was surprised actually that the market closed up on Wednesday after the assassination of a Hamas leader in Tehran by Israel. Nonetheless, it looks like the market has discounted that, Victoria, and is more worried about really the jobs picture, right? But is that recession indicator going to be on, as GDP was 2.8% in Q2? Atlanta Fed Mike McKee was just telling us is forecasting 2.5% GDP in Q3. That doesn't really feel recessionary at all. Why would the Fed come in with an emergency cut?
I'm not sure they will come in with an emergency cut. I know the market is talking about that. Are the expectations of a 50 basis point cut in September moving much higher? Yes, and that's probably more of a possibility than a cut before that meeting. Jackson Hole will obviously be an opportunity for the Fed to lay out its plans and give us a better clue as to what's going on. But I do think you're looking at, look at 2-year yields to Fed funds. It's minus 164, 165 basis points. Again, we only see those levels prior to recessionary periods, 2000, 2008, before the bank crisis in 23, and 98. We're seeing all that. And the labor market is telling you in a lot of different ways, like we were just talking about, with wages coming down, that the consumer is going to be at stake. We're hearing it on the earnings calls as well. Credit card delinquencies going up, auto delinquencies going up, travel coming down, restaurant spending coming down, big ticket items and luxury items spend coming down. So I think the market is starting to get a feel that, okay, we are slowing. The Fed did not, loosen those restrictions at all. So we have a little bit more time where there's still a little bit of squeeze on the consumer. All of that is concerning the market right now. I think we'll see the Atlanta GDP number come down over the next couple of weeks.
And even at the top of this hour, we have, of course, that ISM services data coming out, and you have a market that is kind of on tender hooks here, isn't it, Victoria? If you think about kind of the forward catalyst, how long do you sit out this market for? You had mentioned a little earlier that this wouldn't necessarily be your time to dive right in. What would be that time?
Yeah, I was actually listening to some technical analysts this morning, and they're saying in the short term, right, in the next couple of weeks, you could get a bounce from an oversold position. I mean, look at the levels that we're trading at right now. These are huge drops over the last 2 trading days. So you could get a short-term bounce. Maybe that's an opportunity to trim some names and get some cash available. But in the intermediate term, over the 3-month time cycle, it's showing that we will probably move down even further, which puts us kind of towards the end of October. We know September historically is a very tough month for the equity markets. So I think I would wait a little bit longer. You're not going all in a position at one time. You can dollar average a little bit on these days where there's pullbacks. I would just be cautious and kind of take your time over the next couple of months, because I don't think today is going to be our final down day.
All right, Victoria, great intel there. Thanks so much for joining us, Victoria Fernandez of Crossmark. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. when you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, Citi raising Robinhood to a neutral rating. The analyst says that the company's fundamental story has been improving. Next up, we have RBC Capital Markets cutting Moderna to a sector perform. The analyst notes that the pharma giant's increasingly uncertain outlook as it faces headwinds for both RSV and COVID. And finally, we have Daiwa Securities downgrading Mobileye to neutral. The analyst over there citing the company's materially lower forecast for the second half of the year because of weakness in China, Matt.
All right, one stock, other than Robinhood to watch. Robinhood is down 18% after Citi raises it to a neutral. I guess raising it to a neutral doesn't help very much. Apple though. Berkshire Hathaway slicing its stake in the tech giant by almost 50%. The sale is part of a selling spree that has boosted Warren Buffett's cash pile to a record $277 billion. Here with more is Matthew Palazzolo. He's our Bloomberg intelligence analyst for Berkshire. Amazing, first of all, the sales, right? Because it started with Bank America, which is a stock that Buffett said he could keep forever. Apparently not. He started selling that, and now we find out that he was selling tens of billions of dollars of Apple to a retail investor, and maybe to some institutional investors. This looks like the guy behind the curtain is saying, I'm out at the top.
He's still in, though, to be clear.
So he's still in. I would say this, Matt. In fairness, I think he telegraphed this a little bit in May at the annual meeting. They sold, I think it was maybe like 10% of their position at that time, and Tim Cook was there in the audience, and people were asking him about it. And he had said, I expect this to be a stock that we're going to hold. I expect it to be one of our biggest holdings. But he was just, it seemed like he was letting on like, we're not done with this. He had talked about capital gains taxes maybe going up, and that might be a reason to harvest a little bit. He had also talked about being worried about businesses with some reliance on China.
Is this him telling you that he's calling the top in a lot of ways, or is this a matter of him saying it's better to hold cash now? Let's keep our powder dry. There will be large whale opportunities moving forward. We haven't seen Berkshire make a significant acquisition in a while.
So I would say it took the interest rates going up took a lot of the pressure off them holding cash. So I think they're a little more comfortable doing that than they've been in the past. Buffett's not really known to be trying to play the market to try to sell at the top of the bottom. He talks about buying these stocks as buying businesses. I do think it probably shows a little bit of less confidence in his idea of the long-term prospects of Apple, though.
I did want to ask, what's he going to use this on? He's collecting, of course, the proceeds here. He's still in Apple, but he's cut his stake by nearly half. What's he going to do with all the money?
It's really tough to say, right?
Yeah.
If I knew that, I wouldn't be taking the Metro North to work, right?
At least you're not in a New Jersey Transit.
Exactly.
It could be worse.
Could be worse. So he bought some Chubb stock in the, I believe it was in the second quarter, and that's one of their bigger positions now. You know, that's an interesting story. You know, two insurance giants perhaps getting together. There's no real evidence of them buying more of it, but you know, I think it might be in something that we just don't know. And he's talked a lot about there's just nothing out there big enough for them to move the needle.
But Matt, don't you think, I mean, the fact that the Oracle of Omaha, this is the guy who knows, right? He's selling stocks now and building up a war chest of $280 billion in cash. Doesn't that seem exciting at a time when the market turns over?
It seems exciting. I wouldn't put it though as if he's selling everything, right? If you look into the numbers in the 10Q, really the only big sale in the second quarter was Apple. So he didn't sell most of his other stocks. He's been selling the Bank of America stock in the third quarter. And those two holdings together were half of their portfolio. Even right now, Apple still represents about 15% of their cash and investments.
Matthew Palazzolo of Bloomberg Intelligence, we thank you so much for keeping your eye on that massive cash hoard. Many other people wish they were holding cash right now as well. Want to take a look at this market right now, though, because you're looking at an S&P 500 and a NASDAQ 100 off of session lows. I also want to take a look here at sectors because it is pretty ugly out there almost across the board here, because you have information technology down more than 4.5% really still on the day. Financials taking a beating, down more than 3%. Real estate, energy, all down on the day. I want to take a look here also. Now the NASDAQ 100 looking at a downturn of about 3.5% on the day. Again, off session lows. A fun fact, there are some stocks in the green to be had here.
Yes.
Earlier today, you had SIBO, which is behind that VIX index, also launching a new VIX product later this year, actually hitting a record earlier today. So not everybody loses
Well, and
some volatility.
Kellanova, right, the maker of Pop-Tarts, rising.
Tyson's as well.
There you go. There's a few stocks that are gaining in this market. Here are the indexes. None of those are gaining right now. But they're off their session lows. The Russell 2000 down almost 5%. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's time now for the Wall Street Beat. Global funds have been levered to a carry trade that has been unwinding, certainly since the Bank of Japan raised rates and the Fed kept still. And now the divergence between the rates are widening, and it's unclear how much more pain there is to come. And joining us now is Liz McCormick, Bloomberg's chief correspondent for global macro markets, and explain what is happening here with this carry trade that has existed, because you can say that this is really somewhat of a generational shift as we watch this divergence, but unclear how much it has meant for this trade to unwind. Explain the trade.
Yeah, well, let's remember the trade is forever. Rates were so low in Japan, for example, and it made sense to borrow in that currency, so in a sense short the yen, and invest where rates are higher, the U.S., Mexico, etc. Now, the key to the carry trade, a carry is like you sit there and make carry, interest rate differentials, but the key that it really works to is that volatility is low, because if the currencies move against you, you could lose a lot on the currencies, and that's not only like you explained, the yields have started to kind of go the other way. Bank of Japan raised rates just a little, but they started, and like we can see, and you've been talking about how much people are pricing in, the Fed's behind the curve, we're going to have these massive over 5 cuts this year, so that rate differential got turned on its head somewhat, and volatility. People are like heading to the hills, like you're talking in all these asset classes. When you see this rout begin, it just escalates other things. So people are like, this carry trade, which seemed like the easy trade, is no longer. So you start exiting fast, and it starts to be self-fulfilling, unwinds and unwinds and unwinds.
And I guess that's what we've been trying to get at all morning, is kind of understanding the chain of events here. So if I am managing a big multi-asset portfolio and, oh my goodness, I have to unwind my carry trade right now, how does that exactly affect other parts of the portfolio? How does that translate into NVIDIA being down double digits?
Well, remember, and I think it was the BIS, don't hold me to it, but they did say the carry trade was like expanding to broader things. And Matt, you were joking about NVIDIA, that, you know, you can invest where yields are higher in, say, the U.S., and you could buy stocks. You don't have to be in fixed income. So it seems like it's all building. Now, we don't know all the data where these people are, but say they're unwinding this carry trade, and some of that money was going into stocks. So that's adding to it. And I think what happens, too, is it's like a self-fulfilling, right? People say, oh, it's not going to go that far, but maybe I better get out, you know, like you just, and it starts to feel that fear, you know, that fear concept. So I think it's all kind of breeding on it itself.
If you take a look at, you know, just a simple yen chart, you can understand why the trade is so attractive, right? It's been weakening for so long that it made sense. You can just short the yen and use the proceeds from that short to buy NVIDIA, because NVIDIA has been climbing and climbing and climbing and climbing. Now, I mean, we saw a dip. You can see this is a 5-year chart here. We saw a dip in the yen at the end of 2022. That probably put a damper on carry trades for a while, but surely they came roaring back to life. This isn't the end of it, is it?
No, and I don't want to date myself, but I've been through a few of these cycles where, you know, the trade works until it doesn't, and then everybody's out and they call the death of it, and they come back, because that's just human nature, and it is a good strategy, of course, when it works. So it just, I've just seen it so many times, you know, it's
the circle of life.
It's circle of
Well,
life.
I think what people have to understand, this is a form of embedded leverage in the market, and no one knows how far that leverage goes.
Yes, it's embedded leverage.
Embedded.
What does that mean?
There.
Okay, I get it.
It's under the surface.
Got it. All right. Liz, thanks very much. Liz McCormick, they're talking to us about the unwinding of the carry trade. Let's get to your trading diary right now. What you need to be watching this week. Tomorrow, we get earnings from Caterpillar, Uber, and Airbnb. More earnings from Disney, Novo Nordisk, and SoftBank on Wednesday. On Thursday, we get earnings from pharma giant Eli Lilly, which is going to be fun because we'll get to talk about, what do you call those things again?
GLP-1s.
GLP-1s, which I still need to get hold. I ate so many chocolate-filled croissants when I was in Spain. All right, Alibaba rounds out next week. If you're watching Chinese companies with their earnings on Friday, and maybe that'll tell us something about the consumer, more like in China than here. Take a look at stocks right now. We have not the session lows, but still big drops, right? The S&P 500 off 3.25%. The NASDAQ off 3.5%. Small caps down almost 5%. The rout rumbles on, but it's not as bad as Japan overnight. They had a 12% drop on the Nikkei, the biggest in a decade. When we come back, we're going to talk to the CEO of Vanguard. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Jess Minton sitting in for Alex Steele. Alex is going to go do her TV thing here. What a day in the markets. S&P off 2.6%, the Dow off 3.4%. We'll keep an eye on that. So we need to get some smart market voices here to kind of talk us off the ledge here, Jess.
Right.
We'll start off strong. Gina Martin Adams from Bloomberg Intelligence.
GMA.
Get her thoughts on these markets. Michael McKee, another smart voice. Are we going into recession? I left the studio Thursday.
Right. A lot of things have
soft
changed
landing.
since you went to the beach.
Soft landing.
Right.
We'll see what's happening here. And also, we had Berkshire Hathaway had some earnings over the weekend. They released on Saturday. Right. I don't know why. But Matthew Palazzolo, he covers all the insurance companies, including Berkshire. Berkshire, they were selling half of their Apple stake. That got my attention. They're sold out of Bank of America, so we'll talk to Matt Palazzolo on that. But let's kick everything off because there's a lot to go through with Mr. John Tucker.
All right, let's start off with the data because we are data dependent. Now, this is the biggest part of the U.S. economy. The Institute for Supply Management Services Index coming in at 51.4, better than expectations, much better than the prior reading. It is an expansionary territory, 51.4. Prices paid index, that was up significantly to 57. The services employment index, 51.1. And the services, the new orders also better than the prior reading, better than expected, 52.4. Immediate reaction, actually in the yield space, the two-year yield looks like it's unchanged right now, 387. The 10-year also down just 1 basis point right now at 376. We are pairing some of the earlier losses in stocks. S&P 500 down 2.5%, down 132 points, 52.14 on the index. The Dow Jones Industrial Average 828 points lower. That's down 2.1%, 38,930 on the index. And the Nasdaq right now, the Nasdaq Composite Index 3% lower, down 526 points. So from the July high, the S&P 500 down close to 9%, the Nasdaq down close to 14%, and the Dow down only 6% from its July high. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
That's right.
You know, John, we
Happy
did not
Monday.
get the memo. I mean, because folks, Jess Menton and Lisa Mateo are basically wearing the exact same dress today. Beautiful, bright
It's a fun,
orange
bright
summer dress.
Summer.
They both look stunning. And John, and so I think Lisa took a photo, so it'll be out on
She
her
did.
social.
Yeah, it'll be on the Twitter.
But
It'll
John
be on
and
the
I,
Twitter
we
soon.
did not get the memo.
We look like we just got back from a wake.
Both in y'all's blazers.
Exactly.
It's fine.
So good stuff. All right, thanks, John. So much appreciated. So Jess Menton sitting in for Alex
right.
Steele here for the next couple of hours. Again, John was just reporting this ISM data. Came in better than expected. Let's go right to that because we could use some good news here. Steve Miller, chair of ISM Services PMI. It seems, Steve, some pretty solid results. What do you take away from some of this ISM data?
Yeah, we're certainly happy to see it return to expansion territory. You know, it seems like things are moderating in terms of feedback that we're getting through the survey. We saw, from a GDP standpoint, kind of almost dead even, those that were in expansion versus those that were in contraction, with just a slight percent, about 3% higher on the expansion side. As you see in the number, it's just slightly above in the expansion range. So happy to see it's less volatile than we've seen in the past. With last month, it was about 10% higher GDP represented in the contraction territory versus expansion.
And when you're looking at the Atlanta Fed's GDP Now model, obviously we know that's volatile, but still the next update's going to come later this week, but it's around 2.5% for the third quarter. So I know there's a lot of concern when we had some of the manufacturing data last Thursday, obviously the jobs report on Friday, but when you still have economic growth forecasted to be pretty solid here, how do you sort of unpack some of the latest wave of data here and how this latest, when you're looking at ISM, sort of fits into this?
Yeah, so on average, for 2024, what we're seeing is gradual expansion. The latest reading is about, I believe it's 0.8%, represents about a 0.8% increase in GDP growth. So I wouldn't be surprised to see that kind of a growth number. But certainly what we see in our survey data on average is continued growth in GDP.
All right, Steve, thank you so much for joining us. Really appreciate you coming on and breaking down some of these numbers for us. Steve Miller, chair of the ISM Services PMI. Again, some better than expected services PMI. 51.4 was the actual reading. Consensus was 51. Last period was 48.8, so a nice improvement there. Jess, you've got some trading market news.
That's right.
Here.
So users are reporting issues with certain trading platforms. So right now we have this running on the terminal right here. So you're looking at over 2,300 problems reported with Fidelity. That was around 9:52 a.m. Eastern here. And then 1,400 problems with TD Ameritrade. Also some other ones that are seeing some pressure here, Vanguard, as well as Charles Schwab. So we'll keep you posted as the updates continue to come through on this.
And you know, not a good day. I'm just looking at the WEI function. It shows you where the market's going. It also shows you the volume. I mean, the Dow Jones volume is 80% above the 30-day average for this point of the day. The S&P's 21% higher. So you don't want to have those types of trading platform issues when you have kind of big moving days here.
That's right.
Let's check in on what we're doing with this market. I'm bringing in Gina Martin Adams. I'm just going right to the A team, right to the A team for Bloomberg Intelligence. Gina, I left Thursday, and I don't work Fridays in the summer, as you well know. I come back and the world's, what happened? We left Thursday with a nice soft landing discussion.
Right.
You know, the markets, maybe we'll get a little friendly pullback. We come in today and, you know, I had the NASDAQ off more than 1,000 points earlier this morning.
Also, the last 3 trading days, the NASDAQ's lost 7%, so it's its worst stretch since June of 2022.
Well, I think one big thing happened, and that was tech disappointed forecasts.
Okay.
I think that this has been actually underway for more than just Friday. Friday was an exacerbation of trends that really started a couple of weeks ago. We wrote a note early last week, and we called it 4,344 reasons tech stocks may struggle with high expectations, because tech stock valuations are 4,344 basis points above recent 5-year average. Wow. It just got to the point where valuations were so extreme in an environment where tech stocks were nearly faced with impossible expectations. Now, what's interesting about the earnings season is all the tech stocks beat. They beat forecasts for second quarter earnings, but they were unable to sustain forecasts for going forward margin growth. And they started to talk about how much they're going to have to spend going forward, and will they need to cut CapEx, and they're going to right-size AI expectations. And that created a tremendous amount of uncertainty that was then exacerbated by two big macro indicators last week. The ISM, which fell back to 2023 low levels, which unfortunately would suggest the manufacturing sector's sort of nascent, tiny recovery that it kind of sort of emerged by March is now kaput, and we're back to 2023, which was clearly a recession in the manufacturing sector. And then also the employment report, which, you know, honestly, I'm kind of shocked by the degree of extreme exaggerated move that we've had to the employment report, because all we're seeing is slowing job growth so far, and still extreme entry into the labor force, which is resulting in modest uptick in the unemployment rate. But we are seeing a slowdown in average hourly earnings growth, which may cause questions about the consumer. The other note that we wrote last week is Amazon is entirely holding up the house of cards of consumer discretionary. So I think that also played out last week, is when all your hopes and dreams are on one stock, and that stock cannot sustain expectations, and then the consumer outlook starts to deteriorate somewhat, you see some real weaknesses emerge there.
And I'm glad you brought up earnings, because overall, if you look at the S&P 500, as you know, 12% earning growth year over year here. But you've talked so much also about when people want to argue about the broadening out, but then when you're looking on the fundamental side, what you're seeing beyond tech, as you're seeing kind of that growth is supposed to narrow between tech and the rest of the index. So what improvements are we seeing in other components?
It's actually really fascinating. And I think that this is part of the reason, as much as it feels so painful, this market meltdown has looked very different than the meltdown of last fall. Remember, we corrected 10% in the third quarter of last year as well. It seems like a distant memory because we've had such a great year in stocks so far. But we did have a 10% meltdown led by tech, but the market's decline was 1-for-1 with tech. This time, tech has doubled the decline of the market. And so there is some internal rotation that's quite different, characterizing the 2024 tech meltdown and the overall market impact relative to 2023. And I do think that that's because of the cyclicality of earnings. Whereas in 2023, when tech melted down, there was nothing to kind of hang your hat on, because the rest of the sectors were producing accelerating downside on earnings. Today, that's very different. We're actually seeing earnings growth improve. So ex-Mag 7, the 493, are posting 7% earnings growth. It's the first positive quarter that we've seen in more than 4. So we're starting to see some earnings growth there. The most fascinating part about this earnings season also is guidance. As much as I think the market narrative has been, oh, the companies are guiding terribly. No, the reality is that tech companies have been guiding us to expect less. But the rest of guidance is actually net positive. We're actually seeing positive guidance momentum emerge in the rest of the groups. There's going to be so much confusion as to how this plays out if we do indeed move into a state where we're seeing accelerated layoffs. We're seeing much greater jobless claims emerge, and that's going to imply that maybe we have some actual employment losses around the corner. That's going to create a lot of confusion in this market if we get there, but that's not where we are right now. Where we are is actually companies outside of tech are showing still improvement in their outlook.
We had a guest on earlier this morning that a fund manager just flat out says his note to the clients is buy the dip.
Yeah.
It's pretty bold. I mean,
listen, when you get to a VIX, that's the highest level since COVID. It's very clear that there is panic right now in the equity market, and panic usually results in major buying opportunities. So I completely understand that. We haven't even seen absolute non-farm job losses yet, and the market is already completely and totally panicked. And this is really because tech really drove a lot of our optimism. It was the only source of optimism. Now we're starting to see those tech stocks melt down, and the market is completely panicked.
Although you could have bought NVIDIA at the open today at 92. It's trading at 98 today.
There we go.
Right now.
Andrew Tyler over at JP Morgan's trading desk, so he made that tactical call this morning about buying the dip.
Did? Yeah. Interesting.
Yeah, so we'll keep an eye on.
I remember being on a desk in 1987. going out and pick up the phone.
Right. Did you start right before the 87 crash?
Yes, I did. I was on the floor at 87, October 19th. So anyway, Gina, thank you so much for joining us. Really, really appreciate it. Gina Martin-Adams, she is our equity strategist for Bloomberg Intelligence. We really appreciate getting a few minutes of her time. Michael McKee joins us here, and he does all the economy stuff for Bloomberg Television. Mike, I left the studio Thursday. All my discussions were soft landing, some variation of soft landing. And then today, people are talking about a recession.
Well, it's only Gina's people.
Yeah, exactly.
It's only the equity market. You were talking about 1987. I made a reference this morning when I was on with you to people opening the windows down on Wall Street, and I got a note from a trader who's been around for a while who said the 22-year-old sitting next to me had no idea what you were talking about.
Yeah, exactly.
So maybe we come up with a different analogy.
Right.
I said just a minute ago, it's an Emily Latella moment now because we got the ISM Services Index. Now there's another reference nobody will get. She was the Gilda Radner, comedian on Saturday Night Live, who would come on and say, "Never mind."
Right.
And the services ISM comes in, and everything is higher, including employment, and that was the thing that everybody worried about on Friday, and with the ISM factory orders on factory index on Thursday, and production's up, everything is up, and that number comes in better than expected, and that's 2/3 of the economy. So soft landing might still be in the cards. I think probably what you're seeing, and I'm going way beyond my level of expertise, is that Gina Martin-Adams is right, and that the equity markets were overly dependent on a few stocks that then didn't have great numbers, and you put the data on Friday behind them, and everybody panicked, and now maybe they don't need to.
Also this morning, when we're looking at the yield curve, as I'm sure you saw as well, Mike, it's turning positive for the first time since July 2022, if you're looking at the 2s, 10s part of that. So isn't that something also that you would potentially want to see as far as what that means for the direction of the economy after it was inverted for so long?
Well, yes and no. What people don't realize is that the yield curve disinverts right before recessions because people are anticipating Fed action. And I think that's one of the reasons we saw a big move. It's been slowly flattening, but I think today it was basically the 2-year went way down. The 2-year yield went way down, people anticipating the Fed would be cutting rates and maybe an emergency rate cut and things like that. And right after this ISM number came out, it went back to where it was yesterday. So we're either slightly positive or back to slightly disinverted. So I'm not sure that's a signal, but there are a lot of different signals you can point to these days, one way or the other. And I had an argument with another strategist this morning over the Bloomberg, who was suggesting the Fed needs to act now, and I thought, don't you think it'd probably be good for them to wait a few days and get a little more data and see if this is just a panic or a real collapse? And I think the waiting part is what the Fed is going to endorse.
It just reminds us, how rare is it for the Fed to do an emergency, like intra-meeting kind of rate cut or increase?
Very rare, and they only do it when the market stops functioning. And that's what we saw during the pandemic in March of 2020. That's what we saw in the fall of 2008 when Lehman Brothers went out of business, and we saw the market seize up there. But there doesn't seem to be any indication that you can't trade today. So as long as you can trade, that's what the Fed is concerned about. If you lose money, that's your problem.
Exactly.
Not theirs.
Well, you also spoke to Austin Goolsbee on Friday. He spoke again this morning, but kind of unpack for us what in his reaction to the jobs report, because it seems like, again, they follow trends, and that was just one report.
Well, it was interesting because Goolsbee has been one of the more on Friday. He front run what they might do. He said, we're okay with where we are. Let's see what happens in the rest of the data. And he had a vote this time, filling in for the vacant Cleveland seat, and he did not dissent. He voted for the Fed to hold rates where they were. So if one of the biggest doves was okay with it, then probably the rest of the Fed is going to be feeling okay with it for the moment.
Right. All right. Very good. Michael McKee, thank you so much for joining us. Michael McKee covers all the economics for Bloomberg, and we appreciate getting his thoughts here. The S&P 500, we are off, let's call it 3%, 159 points. The NASDAQ, that's off 3.7% here today, 627 points, down to 16,150. Yields lower, not nearly as low as they were before, but they're about 3 basis points lower on a 10-year, 3.76 on your 10-year Treasury. WTI crude oil, that's off about 1.3%, $72 and change. Bitcoin off 10%, 53,000, off that 50,000 floor earlier today. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The stock sell-off continues. S&P 500, all 11 major industry groups are lower right now. S&P 500 down about 8%, inching closer to correction. Down 8% from the July high. The NASDAQ down 13% from the July high. And the Dow Jones Industrial Average down only 6% from the July high. Again, all S&P 500 sectors are down, led by information technology and the related technology sectors. The defensive, interesting to note, the utilities and consumer staples, they are faring a little better. And at the top of the hour, we did get that economic report. The services sector expanding in July. That's the biggest part of the economy. The Institute for Supply Management Index of Services rising 2.6 points to 51.4. Readings above 50. That does signal expansion. S&P 500, 158 points lower. That's down close to 3%, 5187 on the index. The Dow Jones Industrial Average down 953 points. That is a decline of 2.4%. And the NASDAQ right now, NASDAQ Composite Index, 3.7% lower, down 616 points. And after that ISM report at the top of the hour, 2-year yields come in a little. They're still down close to 5 basis points, 383. The 10-year is down 4 basis points. That's at 375. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele. I'm Paul Sweeney here on Bloomberg Intelligence Program. We're live in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well here. And John was just talking about the 10-year Treasury, 3.75%. We were low at 3.66%, so it's moving all around.
That's right.
There today in the yield
We missed
curve.
that 5% mark, Paul.
Yes,
Our
exactly.
timing is so bad.
Exactly. All right, next guest joins us here in studio, making a big trip over the pond. Chris Watling, CEO and Chief Market Strategist for Longview Economics, based out of London. We got him here in the big town. Chris, thanks for coming into our studio here. What do you make of the last several days here? It's just been a real readjustment for the market in terms of its outlook.
Yeah, I think it's fascinating. I mean, it seems to me we've evolved from sector rotation, which was kind of a mid-July theme, to really a rout, to a liquidation event. And as we were saying just off air, it's really all about the Bank of Japan's governor, Ueda, who came out. They surprised markets with a 15-bit hike. But then, of course, on top of that, he talked about the idea that neutral rates were a long way away. So in other words, there's a rate hiking cycle. And he's done that into, it's very interesting. So the Fed's talked about cutting, and we got a bit of that from Powell last week, a bit firmer. And the BOJ's raising, and they've done that into two extreme positionings in markets. Everyone was short the yen, and everyone was max long the Mag 7. And both those rate cycles changing influence that positioning. So it's like we're in a giant repositioning in global markets and a giant liquidity event on the back of it. So there's a lot going on. It's pretty interesting, not to mention the macro data, which we haven't even got to.
Right. Well, looking at the Mag 7 index here in the terminal, down almost 5% today, so on pace for its worst day, actually since July 24th here. So keeping a close eye on that. But also, you moved neutral to U.S. equities in late July. Actually, it was ahead of the Federal Reserve's decision last Wednesday. Kind of unpack us how you're advising clients to position. Where are you telling them to put their money? And like, what would you want to buy? What would you want to sell at this point?
Well, I think it depends on obviously your time frame. So if you're sort of next couple of months, I'd just be cautious. I think markets haven't finished their sell-off today. We're in the midst of it, and there's more to come. And generally, when markets sell off this sharply, the price action dictates you get a retest, unless we get something dramatic out of the Fed in terms of intermeeting cut or very dramatic strong signaling. So short term I do that. In the medium term, I think one wants to see this as an opportunity to start moving portfolios around in terms of that global sector rotation. So our view is that markets have fashions. Every 6 or 7 years, the global sector leaderships change, and it's been tech, it's been strong. And we think it's now starting to change. We're coming into a rate-cutting cycle. I think you're going to get cyclical re-acceleration in the West. And, we think people should start positioning for that. That's small and mid-caps in the U.S. That's overseas equities, non-U.S. equities. So I think the headline is we're going back to the noughties in terms of what does well. It's like Back to the Future all over again. But what goes around comes around. And I think we're going to get a consumer and housing boom over the next 1 to 4 years across the Western world. And that's going to change the equity sector leadership in the global stock market.
Looking at the VIX here, it's up about 19 points to just north of 42. It was up to a level of 65 earlier this morning, just blowing out like crazy. Does that tell you that panic is out there earlier today?
Well, there's definitely panic, isn't there? I mean, 60 is a big... I mean, I remember when I started in this business, if it went over 20, you thought it was a big number. And then, of course, that's all changed. But 60 is undoubtedly a big number. Very, very rarely do you get above that. So I think that very short term, what people want to watch is, do you get a bullish key day reversal in markets today? You know, obviously, they've opened below the lows. Do they close above levels that they saw on Friday? I mean, it seems a long stretch from here, but still a few more hours of trading. This market is very volatile. It can move a lot very quickly. But look, most sell-offs happen in 3 or 5 waves. So we've had wave 1. We're going to get a relief rally. If you're a trader, at some stage over the course of this week, you want to get involved in that on the long side.
When you're talking to your clients, what are some of their top questions right now?
Well, I mean, I haven't talked to many today because I think the questions might have changed over the last 12, 18 hours. But no, I mean, we've been you know, the big question has really been, when do you get out of the Mag 7? And I think that's becoming increasingly obvious. And of course, I think the really big question will be now, has the psychology really broken in that sector? Is this genuinely the top on a relative basis for the Mag 7? I would definitely argue it is, because it happened on July the 11th, on that CPI day, when we changed, you know, better inflation and so on, and better, therefore, interest rate outlook for the Fed. But look, I mean, there are tons of questions. People are going to be asking about this liquidity out of Japan. They're going to be asking about neutral rates in Japan. What does UA mean? And we're going to be looking for Fed and other central bankers to accelerate their rate cutting talk, I think.
I'm glad you brought up July 11th, the CPI day, when we got that last report for the month of June, because if you look at the flows data, a lot of that rotation, of course, people were talking so much about small caps last month, but now they're coming under pressure. But those kind of income-driven type proxy bond-like sectors, if you're thinking about utilities, real estate, a lot of flows going into that. Even last week, if you counted both of those sectors with Bloomberg intelligence data, it was close to about $1 billion going into those two sectors. And then if you looked at technology, there was a little bit of a bid for the buy the dip. There's around 300 million that went in that sector. But when you're thinking about the bond proxy type corners of the market, I mean, are we still clearly seeing rotation? It's just the rotation's now continuing to move if you're pulling up at those expectations for when rate cuts could potentially happen.
Yeah, I mean, you know, markets sell off, you go defensive, you go bond proxies, that's what you do, that's where you go and hide. So, you know, generally I always think of the market as cyclicals, defensives, and long duration growth. And, you know, there's an argument you go defensive before you go into the cyclicals. But, yeah, it's no wonder we're seeing that. And I think that 300 million into tech is they're probably regretting every penny of that right now. But, yeah, look, I mean, I travel around the world talking to investors. Over the last 6 months, every single man and his dog has owned NVIDIA. And now every single man and his dog is probably selling it, if they haven't already. So
is the buying opportunity then?
Well,
we're stuck like that.
I mean, if you look at tech in 2000, when it had its major TMT peak, the sector derated relative to the market until 2014, which didn't mean you didn't not buy it for 14 years, but it just means don't be too quick.
So outside,
sorry, I was going to say that is the absolute key question here for an equity investor. Has the psychology in the Mag 7 changed? Is global equity sector leadership changing at this moment? That is the crux.
Well, there's an argument to be made that if tech doesn't lead this market doesn't go anywhere. That tech is, by definition, market cap-wise, has to be a leader.
Well, that's absolutely right in the U.S., but outside the U.S., not.
Right.
So globally, the market can be led by other stuff. But you're right, the U.S. will really, really struggle with that.
But the European, I'm just looking at the European markets, you know, selling off today as well here.
Of course. But interestingly, in the first 2 weeks of the tech sell-off, Europe held up really nicely. So, you know, these things have phases. We're now into the liquidation phase. So you've got to sell everything. Gold's selling off.
Yeah, and you don't have in the European markets the tech exposure that they have in the U.S. market.
Not really.
That changes the trading dynamics, the valuation.
Exactly. The sectors are very different. We have ASML, but that's about it, really.
I like SAP, too. I like SAP.
Yes, we got a couple, but it's pretty thin.
Exactly. But you have the European companies have that exposure to China to a greater extent.
They do.
Yep.
They do. We love Spanish mid-caps, just to go really random.
Spanish mid-caps.
Really
mid-caps, okay.
No one's talked about Spain for 15 years, but
That's
the
true.
pigs are coming back.
Okay.
The pigs are back. You remember the pigs in the noughties?
Yep.
They're coming back.
All right.
What goes around comes around.
Very good. Chris Walling, actually, we're going to keep you for a little bit. So, all right, so as you travel around here, are you talking about European equities more than U.S. equities to the folks?
This year, we've started talking about European equities and UK as well. UK, I mean, I don't know how much you've seen of our riots over the weekend, so maybe people are a little off the UK at the moment. But actually, you know, the UK is a very interesting opportunity because we're going to get a consumer and housing boom. There's going to be great earnings growth. It's a cheap market. I would argue we have political stability. It doesn't quite feel like that in the last few days. Maybe our riots haven't hit your news wires. I don't know, but it's been pretty brutal in the UK over the weekend. But yeah, we're talking a lot about European, UK, even some of the emerging markets, but not in this liquidation event. This is when you pick them up on weekdays in this liquidation event. If you're 1, 2, 3, 4 year investor, it's going to be a really interesting 4 years. It's going to be very different from the last 5 to 15, really.
So what do you tell people that woke up to this market and see this kind of volatility here? What are you telling those folks? That this is maybe perhaps part of a reasonable correction, or is there something else going on?
Well, I mean, to be honest, it depends on their time frame and whether they're a trader or an investor. But I think the really important thing here is this, just look at the yen. The yen tells you everything. The short positioning, it's the carry trade currency. Everyone's been funding short yen, long, Brazilian or Mexican currencies, or long Mag 7 or whatever it is. You fund out of the yen, so you're getting killed at the moment. So this is very much a liquidity event, short term. It'll burn through. Hopefully the central banks will turn up. Then you start picking out what you want for the next 12, 18 months. And that is when we think about this move into cyclicals and move overseas or into mid and small caps.
So what's the next big sort of event that you're keeping your eyes on? Because obviously we have Jackson Hole. It's not till later this month, but we'll have a ton of different Fed speakers coming out, and then still a lot of consumer-related earnings in the U.S. this week.
There's a ton of stuff going on, isn't there? Even though it's August, there's no going on holiday. Luckily, I've been, so I don't have to worry about it. But yeah, I mean, I think, are we going to get an intermeeting cut? I think that really depends on how much financial conditions tighten and the price action in markets. What is the market pricing in? Are we going to potentially get 50? Is the market it's probably priced in 50 for the next meeting already? I don't know. I'm out of date. I'm looking at the screen for 20 minutes. But yeah, I mean, I think all of that is critical. The data is critical. ISM services today was very interesting for the soft landing argument.
Came in better than expected. Hey, Chris, thanks for joining us here. Chris Watling, he's the CEO, Chief Market Strategist for Longview Economics, based in London, but he's doing his U.S. Tour here because we work during the month of August, unlike Europeans.
That's right.
So I'm just laying it out there, folks.
Paul's out on Fridays at the
I'm
going to Paris.
On Fridays, so we appreciate it. S&P 500 off 3%, the NASDAQ off 3.6%. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker of the Bloomberg News. With this Bloomberg Business Flash, every stock of the Dow Jones Industrial Average lower right now. Only 10 stocks in the S&P 500 are higher. All 11 major industry groups there, they are lower, led lower by technology and the cyclical areas of the market. They're doing better right now. Apple also sinking, sell-off second only to NVIDIA in terms of market cap destruction. The rout coming in the wake of Berkshire Hathaway gutting its Apple stake. We're going to have more on that in just a moment. On this particularly high volume day, users reporting issues with multiple trading platforms. This includes Fidelity, TD Ameritrade, Vanguard, and Charles Schwab. This according to Down Detector. The economic news that we got at the top of the hour. U.S. service industry activity improving in July. Dose of positive news as the market swoons. The ISM reports its non-manufacturing index rose to 51.4 last month, and that signals expansion, and that is the biggest part of the U.S. economy, worth noting. S&P 500, 164 points lower. That's down 3%, 51.81 on the index, approaching correction somewhere above 8% from the high in July. And the Dow Jones Industrial Average down 1,069 points. That's down 2.7%. Tech-heavy NASDAQ Composite Index right now, 588 points lower. That is down 3.5%. Two-year yield is right now 387. So that's stable, has stabilized somewhat. 10-year yield, 2 basis points lower, and that is at 376. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Yes.
You know what, Paul? Looking at trying to find what are the few bright spots here. Calanova, though, that stock. The ticker symbol's Calanova. Ticker symbol K on this, up about 13%, on pace for its best day since October of 1987. So if you look at the MOV function, the best gainer here in the S&P 500. So that does come on the back of news that we have here on the terminal that Mars is actually wearing a deal for the snack makers. So that's why if you're looking at packaged good companies in the S&P 500, close to flat today, because that is having a massive rally in that stock.
And Mars is a privately owned company.
So it's actually considering buying the snack maker. So it could be one of the biggest deals this year potentially. So we'll keep you posted on that.
All right, bucking the trend on what has been a soft market. So Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so you can head over to youtube.com and search Bloomberg Podcast. I mean, who reports earnings on a Saturday? Only Warren Buffett could do that at Berkshire Hathaway. I was not paying attention whatsoever on the Jersey Shore, but somebody who was paying attention was Matt Palazzola. He's a senior analyst, covers all the insurance geeks for Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker studio. So what'd you learn from Berkshire? I'm guessing more cash and even more cash?
More cash and even more cash. So the big story was really them selling half of their Apple shares. We had mentioned in our earnings preview note that we thought they might lighten the stake a little bit more. I didn't expect it to be this much, but that was the big story coming out of it.
And why was this? Like, what ended up being the kind of cause for them to want to pull back and trim that stake?
Sure, Jess. So we had mentioned also, they kind of telegraphed a little bit that they were probably going to sell more at their annual meeting in May. Buffett had warned about tax rates going up potentially in the future and maybe taking some gains off the table. Tim Cook was actually sitting there in the audience. It was kind of funny that they had sold, I think it was like 10 to 13% of their holdings at that time, and they got questions on it. And it just seemed body language-wise that they would be selling a little more. So I think tax rates, Buffett's been a little weary on exposure to China for some companies, so I think those two played a big role.
And I actually had mentioned to you before when we were off air, kind of trying to pick your brain, because Apple, if just for people to remind them, it was underperformed the S&P 500 tremendously in the first quarter. It was one of its worst quarters relative to the index. Probably like the fourth or fifth worst since the dot-com bubble burst, but then it bottomed in April and has been up close to 30% since then. And so the S&P 500 in that span has only been up about 4%. So you were saying you didn't think even just the rally that we've seen was as much of a factor either as far as why they trimmed their stake.
Yeah, I don't think so. I mean, Warren Buffett's not out there trying to time the market one way or another. And he looks at these stock investments as if he's buying the company. So he also said at the annual meeting he expected Apple to be their biggest holding at the end of this year. It still is. So I mean, that stock was about 40% of their portfolio before this move. So I'm not surprised to see him take some concentration off.
How much cash did they have at Berkshire Hathaway today? And
so
any ideas what they might do with it?
Always a tough one, Paul. I think it's $278 billion, which I thought was a mistake when I first saw it, because they were at like less than 200 before. The sale of the Apple stake brought in a lot of cash. Higher interest rates have taken a lot of pressure off them holding cash.
Yep.
I was calculating that just a simple after-tax return on the cash would help their earnings by at least 5% next year, right? So just holding it will be okay. They bought a big stake in Chubb. That would be an interesting mega deal. I'm not really predicting that would happen, but just seeing that, I mean, I think the next deal Buffett does is probably something we don't even really understand what it is, like, makes unique parts for some materials or something like that.
It's interesting, too, because at a certain point, their holding in Apple was so big that it took up basically half of its portfolio. So in your kind of view, does it make sense to make a move like that?
Yeah, I mean, I don't know if anyone wants to have one stock make up, half of their portfolio. He had said he would love to have owned the whole company at one point or something. It does seem like he was worried about global economic situation. I think the timing of this is just kind of a coincidence why everything imploding today and this happening. Also keep in mind, Bank of America was also their second biggest holding. They've been selling a lot of that in the third quarter. So I do think he's really looking at concentration.
Saw some reporting, I think it was in the Times, about Bill Gates and Warren Buffett relationship maybe not as tight as before. Any thoughts there?
So what has been happening is Buffett's part of the Giving Pledge, where he gives away a bunch of his wealth over time. And
I am not. I'm going to spend every last dollar.
I'm not either. I don't have enough wealth to give away. So, but he was giving a lot of his money annually to the Bill Gates Foundation. What happened, I don't remember when it was. I think it was probably the end of last year. He had announced that when he passes away, that his children are going to inherit the shares in a foundation to be used for charity. I think before that, the Gates Foundation was, I don't know if it was official, but was at least thought was going to get some of that. I don't know about the relationship between the two of them. I just know that that was the case, and I think he's given tens of billions to the Gates Foundation over time anyway.
What about insurers? Because I always think about the insurance companies in relation to, obviously, Warren Buffett. If you look at that group, though, in the S&P 500, down about 3% today, but up 15% year to date. What kind of view do we have as far as how he views that particular corner of the market?
Yeah, so insurance is kind of the engine that drives the float for Berkshire Hathaway. They have a primary insurance business, they have a reinsurance business, and they have the auto insurance business, which is Geico. These companies as a whole, I mean, Buffett obviously loves that industry. They made a big play in Florida last year, which doesn't seem like they redid.
And today, hurricane hitting?
So we have a note out on Hurricane Debbie. Not really a big deal for the insurance companies. Will be very minimal for Berkshire Hathaway, if any impact on them as a whole. But for the group, we seem to be hitting maybe peak ROEs, maybe this year and next year. The valuations generally peak before the ROEs do, so it seems like less rosy times ahead from a fundamental standpoint for the insurance companies, but Buffett hasn't changed his view on insurance at all.
All right, Matthew, thank you so much for joining us. Matt Palazzola, senior analyst covering all the property and casualty insurers for Bloomberg Intelligence, joining us live here in a Bloomberg Interactive Broker studio. Warren Buffett and the Berkshire Hathaway folks reporting earnings over the weekend. Again, huge cash haul. And for those of us on Wall Street, we're just like, how do you ever deploy that? I don't know how you ever deploy that.
I know. Just a little update here we were talking about some of the reportages of outages for the volatility, like Schwab and Fidelity is something we're keeping a close eye on. So Schwab right now, other retail brokerages, users reporting outages as obviously this global stock sell-off still continuing here. So we're going to keep you posted. More than 14,000 users reported outage at Schwab.
All right, not good on a day when the S&P 500 is off 3.1%. We'll have more coming up. This is Bloomberg.